Good morning, everyone. Welcome to our 2018 Trading Winds Fall Kickoff. Hard to believe that it's the first day of fall, apparently at 5 p.m. or 8 p.m. This evening. It's going to be the first, it's officially fall. Hard to believe that. My name is Raul Aurora. I'm the Coaching and Education Coordinator here at Trading Winds. And it's always my pleasure to host these sessions with our head trader, Vince Vora. Now, today we've got a special event. We not only have Vince with us, we have 4 other tremendous speakers, and I think you'll really enjoy it. First order of business is always to make sure that you can hear us and see us. If you can, please let us know by putting in a note in your chat box, and we will get started shortly. Vince, good morning to you. How are you?
Good morning. I'm doing well, thanks.
I want to know who's here from outside of the United States of America. Who's here from England or Australia? Timings, we're all over the place ever since we've gone online. It's very easy to attend these sessions. We've got
Germany. Awesome.
I'm going to try to pronounce the name and say Andelko from Germany. Nice to see you. Rory, USA. Rory, that doesn't count. Even if you say it twice, he said USA 3 times. Nilesh from Toronto. David in the UK. Daniel from Canada. Daniel, nice to see you as well. Nice to see all of you. Vince, this is, I believe, the 4th year that we've done this fall trading kickoff. Why do we do it, and what's important about the fall markets?
Well, the fall markets are typically a busy time. This year should be no different. We should see a very active market. And the reason we do this is to try to give individual traders and investors techniques and strategies that they can use to become better traders themselves. And we've got another great lineup of speakers today.
Speaking of that, we have, along with you, we have Doug Campbell that'll be coming up shortly after you. We have Mark Sachs, we have Mary Ellen McGonagle, and we have Dr. Barry Burns to wrap up the session this afternoon. So there's going to be a little bit of everything. We've got options. We're going to be talking a little bit about futures. You're going to be talking about low price stocks. So we've got lots of great content that's going to be upcoming. Any questions you have, comments you'd like to make, put them in the chat box. It is a busy session. I'm seeing it start to fill up right away. We just started about 2 minutes ago. We'll do our best to get to each and every one. The recording of the session will be sent out to you early next week. So you do have that. If you need to go in and out, you can certainly do that as well. Did I forget anything, Vince?
No, it looks like we have people from all over the place. We also have Andrew from Botswana and Daniel from Nigeria.
Well, the African continent well represented. Excellent. Nice to have you, gentlemen.
Welcome, everybody.
All right. Vince, how did we do in the markets this past week? And we will get started with the session in less than 120 seconds.
Well, it was a pretty active week. Once again, we had a couple of very strong days. Friday was a little mixed. The Dow was up 86 points. The NASDAQ was down 41. The S&P was down just 1 point, and the Russell was down about eight points. We saw some pretty big moves in the dollar and for bonds as well. And, the ongoing concern of rising yields. So those are the things that we need to keep an eye on going forward. Really the dollar, which is at a key level right now, and bond yields. See where those are going. They're getting a little high, and that's something that can affect the market. So we'll have to continue to monitor that.
I noticed that you glossed over the topic du jour this past week, the movement in Tilray.
Oh, yes, we can certainly
look. We're going to talk a little bit about that stuff. If you've ever joined us in the past, this is a serious topic, investing, trading. It's your money that you're putting on the line. But we do like to have we want to give it that seriousness, but we do like to have a little bit of fun along the way. All right, it's 5 minutes after 10 on the East Coast, 7:05 on the West. We'll get started, Vince. Tell us about trading stocks under $10.
Excellent. Well, first of all, welcome everybody. Glad you can be with us on a Saturday. We know how valuable your time is, and we're glad that you can join us. But this morning I wanted to talk about trading low price stocks, and really it should be no different than trading a $200 stock, a $300 stock. The Amazons of the world, the the Baidus, the Googles, it really doesn't matter. But, you know, obviously and I wanted to ask right off the start, if we can, how many of you are new to trading? How many of you are just starting out as traders for the first time and maybe working with a smaller account? Also, how many of you have attempted this before to some degree, but have not, you know, succeeded, have taken some big losses or maybe blown up on account or two? It's very, very common, nothing to feel bad about. But this is really why I wanted to do this session. Usually, if you're new to the business, you're starting out with a smaller account, whether that's, you know, because that's all you have, or just because you're not quite sure, you know, how things are going to work out. So you want to start slowly and with a small amount, or, you know, if you've taken big losses before, and I've been there, let me tell you, my start in this business, which was well over 30 years ago, certainly wasn't great. I had no idea what I was doing at the time and lost a ton of money. Tough lessons to learn. But you know, if that's the case, you're most likely starting with a small amount again. And so I wanted to do this to show you that it not only is possible, but in focusing on smaller priced stocks, you can actually find the next Apple, the next Amazon, the next Netflix. You know, they were all single digit stocks at one point. Okay. And so I want to share with you a simple technique, simple strategy this morning that will allow you to identify those. Now, this isn't a strategy that I created. This was created by someone else, and I'll go through this, but it's a very well-known strategy. If you've heard about it, bear with me. Just if you can follow along, I'll show you how I like to use this and why I like to use this specifically with low price stocks. And then we'll go through a number of examples here. And so that when you walk away, you'll not only have something that you can use that is very effective, in my opinion, but you don't have to take a lot of risk with it. And remember, when you're starting out, because I see a few of you put in that you are new to this, you can do this risk-free, meaning at the beginning, don't use real money. Just use a paper money account, right? Just until you get comfortable with what you're doing. The one thing about this business, two things that really make the difference when you're trading, and it's patience and discipline, okay? Two things that most people struggle with. And the first one, the patience side of it, I always try to encourage people to be as patient as possible, because once you do find a technique that works for you, once you are comfortable with a particular trading system, it's very easy to make up for lost time. It's very easy to scale it and you know, make money in a lot of money in a short period of time. So at first, be patient. Don't take risk unnecessarily. So let's talk about low price stocks. First of all, I am Vince Vora. That's me here on the bottom right. I am the head trader here at Trade & Wins, and I've been doing this for 30 years. I've done it professionally. I've done it privately for myself. And now, most recently, what has it been, about 6 years or so, that I've been really focusing on helping others and teaching more than anything. But over that time, I've developed several systems as well as used many others out there. As I said, please don't take unnecessary risk. Don't trade with real money until you are completely comfortable with what you're doing, okay? So in today's presentation, I'm going to share with you a simple, low-risk trading technique. It is effective. You'll be able to judge for yourself as we go through the examples. Now, I do want to say that even though we're focusing on low-price stocks, generally stocks under $10 here, it doesn't mean you can't use this with other stocks. You can use it with higher price stocks. You can use it with Forex. You can use it with options, with futures contracts, any time frame. It really doesn't matter, based solely on technical analysis, okay? I'm also going to share with you a free, yet what I consider to be a powerful scanning tool. okay? And we'll run some scans together, and we'll see what we can come up with. And so what the combination of that will allow you to do is identify both short and long-term trading opportunities. So it really doesn't matter if you're interested in, just trading for some extra income right now, or whether you are managing a longer-term account. You may have a retirement account that you're focusing on, and really the time frame should depend on how much time you have to devote to your trading. If you have time every day to look through charts and actively trade, you want to be more focused on the shorter time frames. If you work full time or raising a family, have other commitments and can only review your trades once a week or once a month, then you should be focused on the higher time frame. So we'll give examples of each. As Raul said, if you have any questions, any issues at all, by all means, please type them in your chat as we go through. Raul will monitor the chat and interrupt me if necessary. I'll try to keep an eye on it myself. So let's talk about the strategy. Now, as I said, this wasn't developed by me, but it's something that I have used many times and continue to use. It's known as the Guppy Multiple Moving Average System. Short form is GMMA. How many of you have heard it, have tried it, have used it in the past? I'm going to show you how I prefer to use this. First of all, let me explain what it is. So in essence, it's an indicator that identifies both changes in trends, okay? But it does a great job of identifying a trend, okay? And not only that, but the momentum behind the trend, which is what I like the most. So I always say that when you trade with trend and momentum on your side, half the battle's already won before you even enter the trade. Those are the two keys you must always have on your side, the trend and momentum. And I'll show you how and why this is so effective with that, okay? But this is basically two groups of moving averages that you're gonna have, a shorter term group and a longer term group, okay? So this was developed by Guppy. He was actually an Australian trader. The two sets of moving averages, as I said, there's a shorter term set. Now, we are using exponential moving averages, not simple moving averages, not weighted moving averages, exponential moving averages. The shorter set of moving averages consists of the 3-period EMA, 5, 8, 10, 12, and 15. Technically, Daryl says you can or cannot use the 15. I do. So to me, instead of or, it's and. I use 3, 5, 8, 10, 12, and 15. That is one set. So the idea is to make each EMA the same color. So you see it as sort of a band on your chart, and I'll show you in a second. Okay. And then we have a longer term set, which is the 30, the 35, 40, 45, 50, and 60. I like to use the 60 as well. And I color that a different color. So the shorter term group of moving averages will identify your short-term trend, okay? The longer term will identify your long-term trend. So you can see both on the same chart. But the way the two work together, along with price, works extremely well. Okay. Now, if you have any doubt whether or not this can identify some great trading opportunities, have a look at a brief list of stocks that have been identified under 10 that went on to become monster stocks. Now, no one's saying that you're going to get into the next Apple, at $2 a share and hold it until it's worth 200. You don't have to stay in it the whole time. But not only did it identify the sort of the point in time when Apple stopped being a nothing stock that was completely ignored by the market and started to be a very popular stock that everyone wanted a piece of. But it continues, the Guppy system continues to give us great trading opportunities with those stocks. So just have a look at a few: Apple, Amazon, Biomed, United Health, BlackBerry, Nike, Siri, Adobe, you name it, Micron, Nvidia, Celgene, Gilead. I'm sure many of you have either heard of these or have actually traded them yourself. Okay, the list is endless. Now, let's not focus too much on what happened before. Let's focus on how you can identify some of the next big plays. So let's bring up my chart platform here. I'm going to start off with a chart of Apple and the monthly time frame, and I'll explain why in a moment. But what you're seeing here are the two different bands or two different sets of moving averages. The shorter set in blue. Okay, so if I zoom in, and let me go to the settings so you can see. So I don't know why they're in the separate order, but as you can see down here, moving average exponential, right? A 3 period on the close. They're all based on the close. So we have a 3 period exponential moving average. We have a 5. The 8, there's the 8. They're out of order here. 10, 12, and 15. And if I go in there, and there you go, you see the blue. So that's the blue set. And then we have the 30, 35, 40, 45, 50, and the 60 down here in red. Okay. So this is what they look like on the chart. We get a shorter term range and we get a longer term range. So one of the ways to easily tell whether you have a trend in place, obviously, it's very simple, especially on a longer time frame when you see price action sloping in a particular direction. Okay, but having the moving average on there and having them sloping in the direction of price is not only gives you an idea of trend, but also the amount of momentum behind the move. So in other words, you could have a very slight slope higher, which is a bit of momentum. You can have more momentum, or you can have, very dramatic, significant momentum behind the move. So the slope of the moving averages really matters. Okay, and you typically want to look for about a 45-degree angle to consider it a significant amount of momentum. But while it's on here and price is fluctuating, whether you're on the monthly or you're on the daily, or even say a 5-minute chart, however you want to use this, okay? However you want to use this, you can see what the stock is doing or how it's trending, in the near term versus the longer term by looking at these two bands, okay? So even here on a 5-minute chart, okay? Here, looking at Friday's action, here's the start of Friday right here, okay? We started off moving lower. But you can also see that even the longer term bands were facing lower, okay? So when we started to pull in here, we started to retrace, but the longer term bands continued to point lower. It was pretty clear that this was just a temporary retracement before a continuation of that move lower. And that's why it's helpful to have the shorter term and the longer term bands on your chart at the same time. So, and if you're looking, say the daily, the weekly, or the monthly, whatever time frame you like, it's pretty clear that when the bands here are all stacked appropriately, one over the other, in other words, the 30 over 35, 35 over 40, and you can paint these different colors if it helps you, okay? But you have that slope. Look at that slope. It's about a 45-degree angle. That makes any of these little pullbacks here great opportunities. So you can do one of two things. You can wait for the blue bands, the shorter term bands, to come into the red and come back out, or come below it and break back above. Or you can just wait for price to pull below the bands and back or within the bands and pop back out of the bands, okay? And these aren't small moves. They may look like small moves, but here it popped back out around 148, 150, you know, when as high as 164. So these aren't small moves that you're seeing here, okay? But if you're starting out with a small account, it's going to be very difficult for you to say, well, you know, I'm going to buy $150 stock. You know, to buy 100 shares, that's a lot of money, okay? If you buy just one share, then you're not really making any money. You know, you're going to spend almost as much in commission as you will on a profit, even if the thing moves $5, $10, right? It's going to be very difficult. So by focusing on lower price stocks, not only can you afford it with a smaller account and buy more shares of it, and even diversify. I might have several different positions on it at a time, but you're also taking a lot less risk because the amount that those stocks fluctuate are going to be a lot less than, you know, $150 stock, even a $50 stock, right? But at the same time, you're giving yourself that potential for that single digit stock to eventually become an Apple and Amazon, and you grow your account along with it. Let me show you what I mean. If we go back to the monthly here, and we go all the way back down here to 1999, okay? You know, Apple was trading under $1 at that point, okay? Let's zoom in for a second. Let's see if we can see it a little clearer. There it is. So back in here, you know, around $1 or so, just about a little over $1. If you look to the far right, there's the price bubble. You can see it as I hover my my mouse over it. And it's difficult to see here. I don't know how clear you can see it on your chart, but at the time it was just consolidating, right? Really wasn't doing much. And the bands were flat. There was really nothing to do. Then it moved a little. It went up to about $5 or so and then pulled back and consolidated again for many years. At this point, hardly anyone was focusing on Apple. Not many people were really paying much attention to it. The media wasn't talking about it much. But suddenly, here, it started to move. And you can see the blue bands started to slope higher. And that's very important. That means that a new trend is starting, with blue above the red, and with momentum being behind the stock. Even though we might not know why it's happening, we don't really care. We just care that it is happening. Now, there's a couple things you can look out for. And one of the best techniques that I'm going to show you here with the Guppy method is to just use simple trend lines, okay, just by drawing trend lines. Now, when you're drawing trend lines, you want to attach highs to highs and lows to lows. There's no perfect way of doing it, but understand that you can attach any previous high to any future high, any low to another low. You don't want to attach high to low. It's either high to high or low to lows, right? So if we want to come down here and draw a line, you can see we can touch several of these previous lows. And the more lows you can touch along the same line, okay, the stronger that area of support is. The more highs you can connect, the stronger the overhead resistance is at that point. Until you cross it, then it becomes support again, okay? But it's a very simple way to also identify an area of consolidation. That's effectively a channel, right, that it was bouncing around in for several years. So from 2001 to about middle of 04, or the beginning of 04, okay, about 3 years, it really did nothing but bounce around between, 80 cents and $2. It just bounced around there. Then it finally broke out. So it's very important that you look for those areas where it breaks above previous highs, okay, at least one previous high, but if you can take out several, it's even better. And we start seeing a slope in the moving averages, and they're stacked appropriately, meaning blue above red for a long trade, right? That was the start, and it started to take off. Now, here's a previous high that if we extend out, what do you notice? We broke above it, came back to retest it, and bounced again. So in here, first of all, down in here was an opportunity of a stock that, we would consider for about 3 years to be dead money, right? That's what we would call it. That's dead money. You put your money there, but it doesn't really do anything for you. It just sits there. It's not earning anything for you. It's not doing anything for you. So why park your money there if the stock is just going sideways? But as soon as you see it take out the high of that range with that slope and price moves above the bands, right? Now you know something's up. Now you do know by having a previous high here that there is some overhead resistance. So you can assume that from here, once we get here, we could hit that level and retrace again. So you've got a range of about 250 up to about 550 there, right? Still, that's a 100% move. Now, and if you put your money in when it breaks above that, at say 250, you know that if it retraces at this point, the same range is going to act as support, okay? So it carries a very small amount of risk for you, because even if it were to bounce back now, first of all, it can only go $2 to zero, but it's going to find support around the $2 mark, right around the highs, those previous highs, right? And your risk to reward is much more in your favor. You have a very small amount of risk, but the upside is unlimited. Basically, at the time, this back in here was the all-time high, right? The $5 range. That was the all-time high. So we know getting above there, sky's the limit, right? There's no overhead resistance. The stock can continue to move. And in fact, it did, right? So, and now when that happens and it breaks to an all-time high, that's when others start to pay attention. That's when volume comes in, and especially when it gets over the $5 mark, that's when stocks get on the radar of mutual funds, okay? And that's when institutions start paying attention, okay? Because a lot of funds have a stipulation that they cannot hold stocks under $5, okay? But because they're considered penny stocks at that point, over 5, they can. And when you have sector funds, for example, okay, and there's a new stock within a sector that moves above $5, they need to add it to the fund to represent that sector fully. So automatically buying comes in on a new high above $5. And so if you look back now at Apple and what happened, it never really looked back, right? From that point on, the company went on to explode. Now, not every stock is going to be like that. And at this point, we had no idea what was going to happen with Apple. But it's not only very simple to get in and carries a very small amount of risk, but the upside is unlimited. And, we don't have to stay in it the whole time. We can scale out. We can set our targets. And we can just watch price, and as long as it remains above the bands, there's nothing to do. When it comes back in, you can take some profit, but have a look at when it pulled back here. It pulled back. What happened to the red bands? Absolutely nothing. They maintained their slope. They maintained their proper order, right? They weren't crossing each other. They were all stacked appropriately, 30 over 35, 35 over 40, etc., and sloping higher, which means the trend was in place. So all we were looking at was price to come into the bands and pop back out. And it did so back in here. Still under $10, about $9.80. And that gave us a move up to here. And you can just repeat that process all the way through. Back in here, all the way through. Okay? Now, this was the monthly chart. It works the exact same way on a daily, on a weekly, on an intraday chart, it really doesn't matter. Okay, have a look at Amazon. You know, people weren't always talking about Amazon. Let's go to the monthly when it was down here. Have a look at this from 99 basically to 07, right? Not a whole lot was happening. Now, if I zoom in here a little, let's see if that does it. All through here, have a look. Back in here, okay, it was about a $20 stock when it first was released. And, you know, people jumped in and went kind of crazy. It settled down, and then it moved back up. Now, at this point, yes, it was a higher price stock, 26. So maybe it's not the best example in the world, but it works the exact same way, right? Look at the bands, right? See how in here, the red bands were sort of crossed, overlapping each other, okay? So you don't have to, at that point, there is no longer term trend, right? You want to wait till they're stacked appropriately. So maybe you don't jump in there. You want to be very, very conservative and wait. You see how here when they were stacked, you got that big pullback. They were stacked appropriately, sloping. Price moved back above, and off it went, right? It took off. And then from then on, it's just the same thing over and over and over. So this is what you want to look for. And the more space you have in between each band, the better it is, the stronger the trend, okay? Have a look at Netflix, okay? Down in here, let's go back in time. Again, starting out here at 35 cents. When it breaks above the bands, right? You know, at $1.18 or so, moves up to over 5. Now, again, we didn't have trend there. You don't. To me, it's worth risking because for $1, no problem. I take that bet every day when price moves from below both bands to above. Take that every day. But you don't even have to take that risk. Okay, you can wait until it shows you that you've got some slope. Once the bands are stacked appropriately, pretty clear. And there are a lot of other technical analysis techniques you can add to this. So if you have favorite techniques, like even candlestick patterns, like an engulfing pattern that you like to use, or other indicators that you like to use, like the stochastics or whatever, you can certainly incorporate that into this. I'm just giving you the basics. And what you really want to look for, as I mentioned, incorporate trend lines, right? Breaks above previous highs. So if we look at this previous high and we carry it across, right? There's that break. Come back to retest it and hold. Bands are sloping appropriately, all stacked in the right order, right? It was a $6 stock. And what happened next? It went from 6 to 40 in one shot, right? So that's the kind of trade that can grow your account, okay? Now, again, you don't have to trade the monthly. You can do this on a daily or any time frame. But it's a very simple technique that if you identify stocks that are consolidating, mark a high of that range, and watch for price to move from within or below the bands to above, and identify some slope in those bands, and if they're stacked accordingly, that is a very, very high percentage play for upside. Why? First of all, you have a trend. If both the shorter term trend and the longer term trend are sloping higher, that means both are aligned, shorter term and longer term. So that's one thing stacked in your favor. The higher the degree of slope, the more momentum there is behind that, which is another thing. But more importantly, you've cleared the high of that range, okay? Meaning there is no overhead resistance. You're at an all-time high. And not only that, but you also know that once you get into the trade, right behind you, there's a lot of support. There was, about 5 years of consolidation, all the volume put into that. If the stock starts to retrace, you know, it's not just going to flush right through there. It's got 5 years of volume to work through. So you're looking at a very minimal amount of risk. Okay. I think Dimitri asking what platform this is. This is the Thinkorswim platform. You don't need to trade on a specific platform to use this. Any charting platform has moving averages. You just put on the, remember, they're exponential moving averages. Okay, just put on the 2 separate bands of moving averages and you'll be fine. I can repeat them again for everyone if you need to, if you need me to. Any questions on this right now? Because the other thing I want to show you before we wrap up is that free scanning tool. Okay. While Raul looks through the questions, let's look at one more example. Nike, right? Nike from 1999, 01, 02, 03 was really not doing anything, right? Back in here, let's zoom in and go back. Right through here, it was just bouncing around in a range. You know, if you take your rectangle tool, you can box it, right? Okay. It was just bouncing around. Okay. The more important thing is mark the highs, right? Mark the highs. What happened when it marked the high, when it broke the high? Okay, look at this point. A was an $8 stock, very affordable. B, both the blue bands and the red bands were trending in the same direction. Both had nice degree of slope, which means momentum. So something was going on here, right? If you look back in here for clues, right? When it broke above here, was it a high percentage play that it was going to continue going? No, it wasn't. You know why? Because even though the shorter term bands, the blue bands were pointed up, the red were flat and all overlapping. So you didn't have a longer term trend. Plus, you didn't break a previous high, right? Same back in here. The blue bands had started to slope, but the red ones really weren't. Now here, you break above that high, which means no overhead resistance. It's an all-time high at that point, right? There's nothing standing in your way. But now you have both short and long-term trend in the same direction with a high degree. What do you get? You get a pullback to retest that same level. You see what I mean? This is why it's safe. If you get in here and it pulls back to retest that level, more often than not, it will hold that level because previous resistance becomes support now, okay? And price moves back above and off you go. It consolidates again. The long-term trend stays intact. Price moves back above and off it goes. And it's just a rinse, repeat, over and over and over again, okay? Now, certainly there are ways to select stocks that will give you a higher probability, and I'll talk about that in a moment. I want to show you that scanning tool. Were there questions, by the way?
Just a couple of questions regarding the length of the time frame. Dimitri says, does the strategy work with trading futures and day trading? Rick says, very nice system. Is it only a long-term trading, or can it be used for shorter time frames as well?
It can. Let's look at the SPYs, okay, the S&P 500, and let's go to a 5-minute time frame, okay? And let's zoom in here. So here's Friday's action, okay? Thursday and Friday. Here it is. Now, when the blue bands cross below the red, you know, that tells you the shorter term trend is turning around. We're moving from an uptrend to a downtrend. Okay, this is on a 5-minute chart of the SPYs, the S&P 500. Okay, you can see the reds turned as well. They were all crossed each other. So at this point, getting in here just meant higher risk. When price goes from one side to the other, yeah, usually it moves, but it's more risk because you had a shorter term downtrend. You did not have a longer term defined downtrend, right? Because the bands were all overlapped. Once they spread apart and they stacked appropriately, this was your opportunity because you got that retracement here, but the longer term trend was intact. And now when price broke back below the blue lines, that was your entry, and there was your drop. Okay, it doesn't matter whether it's a 1 minute, whether you're going long or short. Okay, this is a 1 minute chart on the S&P, and you can see plenty of trade opportunities, not only to the upside but to the downside, whichever way, it doesn't matter. A 15-minute chart, it won't really matter. Hourly, I love the hourly time frame with higher price stocks. This is an index, okay? This is an index, and there's plenty of opportunities here. Just look at the bands, okay? The best opportunities, when you have the highest degree of slope, you get that pullback, and these bands maintain their slope and the proper order, and then price just pops back above. And remember, don't overlook clearing a previous high, right? Markets move like a staircase in most cases, right? A zigzag. So you have the bands down in here showing you that there is a trend, right? And how much momentum there is behind it. You're just waiting for those pullbacks. Now, whether you want to identify the entry as soon as it pops above the band, or whether you want to wait to clear the high, either way, it usually works out very, very well. Any time frame, any market. You want to look at Forex, right? Here's the USD CAD pair. Have a look at all the trading opportunities in here, all the way through, right? Downside, upside, any time frame. This is 1 hour. It really doesn't matter. Okay, very effective. Now, to scan for opportunities, if you go to finviz.com here, they offer a scanner. You can see in the top left here, it's called a screener. It's free. As you can see, I'm not logged in or anything here. There is an elite service where you pay monthly for more features. You don't really need it. The screener here, if we go in, you can search by many different factors. So which exchange you want, by price, short float, you name it. There's fundamental issues like EPS growth, quick ratio, etc. And there's technical factors. I'm going to open it all here and start by price and just put under $10. Okay. Now, automatically, it'll change down in here, and it'll give you all the stocks under $10. And then you can sort by clicking up here on price and sort them in the right order. Ignore the ads. It's obviously the free version, but you can see how many there are here, pages and pages, right? Way too many to go through. So we can try to pare it down. We can look at average volume, right? And say put over 500K, and it'll shorten the list. Right? Still not short enough. Let's put it over 2 million. Let's go to current volume, and you want the really big names. Let's go over 20 million. Okay? If something is trading over 20 million shares, there's got to be something to that stock. Now we're down to about 19 stocks. You can just hover over here and take a quick look at the chart to look for long areas of consolidation like this, and then mark those highs and go from there. You can also have different views. If you click on the chart tab here, it'll show you all the charts, and you can skim through them, okay, looking for quick opportunities. And then, of course, we can look for items like news and dividends and so on, okay? Let me tell you, because I'm running out of time here, what we're going to do is hold what we call a pro class on this, a mastery class. If you go to tradingwins.com/U10, it's a short form for under 10. tradingwins.com/U10. We're going to have a live class on October 2nd where I'm going to go into much more detail on this strategy. But what I want to do during that session is give you a full plan. So what we're going to do is talk about the strategy, but show you how to build a watch list for it, scan for those opportunities, find the really strong stocks, the ones that have the potential to become the next Apple, the next Amazon, etc. And the way we do it is we're going to add some elements of fundamental analysis in there and a few other things using that scanner. And I'm going to give you the scans that I use, the specific parameters for the scans that I use to identify those. And together, we're going to build that trading plan for you and even show you how to track your trade so you know whether you're on the right track or not, and you can make adjustments along the way. Okay, we're going to go through all of that on October 2nd here. And again, it works on stocks, options, futures, forex, you name it. We're also going to throw in a 30-day membership to our Trading Wins membership, pro membership. What that entails is you're going to get 5 videos a week from me every Sunday to Thursday evening. Send out a video recapping what happened in the markets that day and where I think things are going. And that's also where I share some trade opportunities that I'm looking at. Also, with our pro members, we meet twice a week, every Monday evening and every Thursday morning. We meet live for an hour. You get to come into our room, ask me any trading related question you like. So it's a great place to follow up on this strategy or anything else that you're having difficulty with your trading, and I'll try to help you out. And as a member, every month we do a free course of the month for our members, and you'll get that as well. And that's all recorded and put in your own video library. We're doing all of this for just $27. Obviously, it's worth a lot more. We want to give you an opportunity to have a look and see what we do here at Trading Wins, and hopefully you become part of our family here. So tradingwins.com/U10. Raul, can we put that link in the chat box?
It's already there.
Okay, you can just click on the link in the chat box or go together. And I apologize. I think I've run over by a couple of minutes.
Don't worry, there's a small penalty for that. We'll take care of that.
Any questions, by the way, before we move on? Because I know it was very, very quick. If you have any questions on this that I couldn't get to, you can send me an email. Email me at info@tradingwins.com. We can also put that in the chat for you, and I'll be happy to answer all your questions. And so I'll pass it back to you, and we can bring on our next guest.
John says, would you take $26? John, just because you made me chuckle with that comment, yes. You buy that course today, and we will send you a nice crisp $1 bill in the mail. All right. David was saying, can you please provide the moving averages for GMMA? David, we'll put those in the chat box so that everyone can share them. We want to bring on our next speaker, Doug Campbell. Let me get him all set up, and then we'll do his introduction for him. So just give me a moment. Vince, that was a good training class. Lots of positive feedback.
Yeah, it's never quite enough time to go through that. But, you know, again, I think this for me has been something so easy to follow and so consistent that for those of you just starting out with a smaller account, or those of you just, you know, trying to get over that hump and become consistently profitable, I think using something like this will be very effective for you.
All right, Doug Campbell, can you hear me? Doug, are you there? I can't hear him. Vince, can you hear him?
No, I can't either.
Okay, let me give him the presenter controls. Maybe that'll...
Maybe it's just the mic. He is logged in. We see him.
Yes,
Doug, we can't hear you.
There we
do
go.
a sound check?
Yep, I'm good now.
How are you, sir?
I am great. How are you this morning?
Very well. Thank you so much for joining us. I've given you the presenter controls. I will let you know when I can see your screen. I can see your screen.
Okay, that's not the screen I want to show. So how do I fix that?
Geez, that could have been dangerous, huh? If you had something else up there.
No, that's fine. I mean, I don't have anything that, let's see, I need to fix.
You know, I was going to say I need a little bit of excitement on my Saturday morning here. While you're doing that, Doug has been involved in the market for more than 27 years. He was able to fulfill his dream of becoming a full-time trader 12 years ago and has since supported his family from trading profits. He loves trading options, but he's really a swing trader first and foremost, and enjoys sharing the lessons that he's learned over his time in the market. His approach to trading is simple. He loves using simple charts, minimizing indicators to focus on the most important elements of trading, which is price. At Hit and Run Candlesticks, his company, and Right Way Options, the key to success is quality education. Helping other traders realize their dreams is his way of paying it forward. Doug, very well said, very well put. I'll let you get at it. You'll have until 45 minutes. What is that? It's 11:35 Eastern time.
Very good. Well, thanks everyone for being here today, and I really do appreciate it. You know, it's always humbling to me when on a Saturday morning, especially during football season, we have people showing up to listen to what we have to say about trading. So thank you very much for being here. I really do appreciate it. And also thank you to Westmark for inviting me to speak today. I really do appreciate that as well. So today I want to, obviously in 45 minutes, I can't teach you everything I'd love to teach you about trading, but I want to teach you some of the a few concepts that I think are extremely important to be successful and consistently successful as a trader. So I'm not real familiar with the GoToMeeting system, but if you have questions as we go along, please feel free to post them. If I can see them, I will try to answer those for you. Let's see. Is there any way I can see that easier? Hold on.
Doug, you should have access to the questions now.
I do. Okay, great. Okay, so now I've been trading for a long time, trading full time now. In my 13th year full time and being able to support my family and do what I need to do in trading. And one of the things that I want to share with everyone is I'm just like you. I've got no fancy degrees. I've got no fancy financial background or anything like that. I was a contractor. I built houses for years. That's how I supported my family for most of my life. And what I want to share with you is after years and years of tremendous frustration, tremendous failure in trading, I finally figured out that simple was the easiest way to trade, and just keeping it simple was the easiest way to trade. You know, if you take this old quote here, simplicity is the ultimate sophistication. And I've kind of taken that to the nth degree. I trade very, very simple with a very simple chart. And I can tell you we profit consistently in hit and run candlesticks and right way options, just simply because we keep our trading so simple. And it really ties in really well with the last presenter with the Guppy chart, which is actually a fairly simple chart. It has a lot going on it, but it's a fairly simple chart. Well, when I was failing as a trader and I was really literally getting ready to quit as a trader, I learned something very simple. And it was that aha moment that changed my life as a trader. Okay. And I don't know why it took me so long to figure this out. I'm pretty thick-headed, I guess. But the easiest way to make money in the market is to find a trending stock that wants to go up, wait for the next entry, and then follow it up. Now, this almost sounds so simple that you almost reject it out of hand. And by the way, I'm going from here directly to charts. So I'm not going to spend any more time with slides. Those kind of get annoying. Let's just go to a chart. Now, when you look at my screen, 99% of all of my trades come from a chart that's this simple. You can see black and white candles, white background. And by the way, I think this is really important for everyone to understand that the simpler your chart, the easier you're going to be able to see the price pattern, the price action. And another one of those aha moments is when I realized that what I was doing as a trader for many years is I was trying to find out the perfect combination of indicators, the perfect combination in a scan, the perfect thing to get me to the right trade. And I was doing everything except watching what price action was doing. And once I realized that price was the most important thing to watch, everything became much, much easier as a trader. Much, much easier as a trader, because all I had to do was learn how to follow along with price action. You see, I gave up this idea years and years ago that I can predict the market. And one of the things that most people want to focus on is trying to predict what the market is going to do next. And I don't even try to do that anymore. Believe me, it takes a lot of stress off of you when you get rid of that idea that you can predict. You know, I've been married 33 years to the same woman. And I can tell you without a shadow of a doubt, I cannot predict what she's thinking from moment to moment. After all that time, you would think I could figure that out. But I can tell you exactly I can't. Now, if I can't figure out what she's thinking after 33 years, what makes me think, or anyone think, that they can figure out what the market is going to do the next hour, the next day, the next week, with all the different factors around the world affecting the market? But we spend so much of our time trying to predict the market, we end up missing out on great trades. Great trades. And it's very, very simple to do. So I start out with a basic chart like this. Now, 99% of all of my trades, all of the trades that I suggest to Right Way Option members, come directly from a chart just like this. Now, the only difference is that I draw up a chart. I tend to take my time and draw up the chart with just some simple drawings. So let me take you to a trade that I just closed on Friday. Procter & Gamble. Now, not too many people look at Procter & Gamble because Procter & Gamble is not one of those stocks that's in the news all the time. But notice how clean and deliberate the price action is in this chart. Now, it may still look a little bit messy to you, but let me put my drawings on that chart and show you how I trade it. Each one of these pink lines that you see, I started putting pink lines on the chart just so everyone who's a member or part of our trading room, they get the opportunity whenever I'm looking at a chart, they can see how it's marked up and they can see how I've placed alerts on that chart. Now, I closed the final part of this trade on Friday for 140% return. Now, that was using options. But you can see these trades were very simple to trade. Now, I have a couple things that I think are really, really important that I want to spend a couple minutes here explaining to you. Trend is of ultimate importance, okay? Of ultimate importance. So for the first thing I want to do when I'm looking for a trade, I want to focus in on the ability to find a trend. Okay, so I'm going to look for any chart that's showing a trend. Now, how does a trend get established? Well, we've all heard the explanation that an uptrend is a higher high followed by a higher low. But I think one of the things that gets missed in that conversation is we try as traders, we try to catch the bottom down here all the time, right? We're always down here trying to pick that bottom. And because of that, we're truly anticipating or trying to predict the direction of the market. I don't do that. I don't even try to do that anymore. I don't worry about picking a bottom. I don't worry about a top. I simply follow the chart when the chart tells me it's ready to go up. And the trend is a key factor in that. So notice this trend right over here. This trend really doesn't get confirmed or established until we make that first higher low. And then buyers step in to confirm that higher low. Okay, my first entry into this trade, I recognize, and let me back this chart up just a little bit. I recognize this chart as a potential trade once we broke through that price resistance right there. And notice that the trades that I am going to favor are always going to be that entry signal that comes very close to the trend. I don't know why this works. I just know that it does. The majority of the time, if a stock is trending either up or down, it will find a way back to the trend. over and over and over again, it finds its way back to the trend. And so I just simply wait for those charts that are proving trend, and I wait for them to come back to trend. And you can see my pink line right here was my alert to enter that trade. Now, a pattern that I think is really important to identify nowadays, it's happening an awful lot. When we get a move up in a stock, and if you guys have questions on this, please ask. But when we get a move up on a stock, okay, the pullback here, oftentimes anymore, when we get the pullback, we end up getting a candle, a buy signal right here. That first buy signal, just like this first buy signal that pops up right here, I'm finding that buy signal is often being sold into anymore. So be careful. If that buy signal appears away from the trend, watch out for entering too early. Now, the good news is if you do get in too early, okay, the good news is if you get in too early, normally it will still hold support, but you'll have to deal with the pullback or the consolidation in that move. Okay, so I watch for that signal to be generated at or near that trend, and then I place an alert. Now, I don't predict the entry. I simply wait for the trade to come to me. I got out of that business of trying to predict, and I just follow a trade. So you can see in this trade, there were multiple potential entries into this trade. I just exited the final piece. My initial entry into this position was here, and I scale out of trades. I see a question: how do I determine exits? I sell stocks at or near my trade goals, or at or near price resistance. Okay, 2 rules I'd have you guys write down. These 2 rules changed my trading life. Only buy stocks at or near price support. Second rule, sell stocks at or near price resistance. And you can also use that sell stocks as that's where you short, at or near price resistance. Very, very simple rules. Now, make sure you add to those rules with a buy signal. Okay, so you want those buyers coming into support. We don't need to predict this. What I usually do, if you see that alert right there, that pink alert, if I'm real close to trend and I see buyers stepping in, that's where I enter. And the reason I enter there is because my stop loss is very close. I can have a stop loss right under here. Isn't that a confirmation under here? We've tested down here several times that there are no sellers below that level. At least at that moment, there are no sellers. Can this trade fail? Yeah, they absolutely can. But I'm going to have a very low risk entry. Okay, so the trade is, and it always will be, very near trend and very near a price support level. Okay. Question, do I enter at the end of the day or do I do it during market hours? If I'm confident, this comes into another class. And by the way, you can get that class free on my YouTube channel, and I'll share that link with you here pretty soon. But evaluating the overall market condition. If you're confident in the overall condition of the market, buy that trade as it's moving up, because your stop loss is close. Remember, the goal of our trade is we want to take low risk entries, right? And here's a mistake that I used to make over and over and over and over again, is I would wait for so much confirmation that the stock was going up. I was literally buying it at price resistance. and immediately suffer the pullback. In fact, I had a complex about it. I could have sworn someone had to have been watching me, because every time I pulled the trigger on a trade, the stock almost immediately pulled back. It was because I was waiting too long to enter the position. And I ask this question a lot. I do a lot of personal trade coaching with individuals. I ask this question to folks a lot of time. Would you rather have a risk in a trade where you enter here and have a stop loss here, or wait till you break out here and still have your stop loss down here? Take less risk in the trade. It's really, really easy to do. So all we need to do is look for those low risk entry points to enter those trades. So this is just, one simple example. Let me show you a trade that we just entered. This is a simple trade in Cisco. You can see beautiful, nice trend. Notice we moved, even on this earnings gap, we moved over to trend before we moved. And then we consolidated, nice long consolidation after this move. And that nice long consolidation was nothing but a breakout of a longer term resistance. We broke out, we came back, we tested as support. Our entry into this trade in right way options is right here in that trade. Now, a good deal of the right way options members have already taken profits. They took profits in 4 days on that move of more than 20%. Now, so there's a question in here. How do you determine an exit? Well, one of the first things I do is I have a trade goal. You see, I think this is extremely important for any trader to do. If you don't know where you want to go, you starting at point A, if you don't know where you're trying to go at point B, how are you ever going to get there? And so what I mean by that is you need to determine what your goal is for the year, and then break that down into a monthly or weekly plan on how you're going to achieve your goal. And I absolutely do that. I know exactly what I want to do every trade I make. Yes, it does. It works great for downtrends as well, and I'll show you some of that here in just a second. So there's that simple entry into the trade, just following along with the price action of the chart. It didn't require any other indicators. Now, I'm going to share with you an indicator. It's called the volatility stop indicator. It's already built into TC2000. If you don't have TC2000, we've also got the code available for you for Thinkorswim charts, and you'll have to reverse engineer it for anything else. Now, the volatility stop indicator is nothing more than an average true range indicator. When you see it, most people come to me and say, well, that's parabolic SAR. TC2000 is a charting platform. I think it's the best charting platform out there. But TC2000, and by the way, there's videos on my YouTube channel about TC2000 and how to use it. So TC2000, this is my charting platform that you're looking at, and it makes it very, very easy for me to get to stocks real quickly. But it also has this indicator built in. It's called the volatility stop indicator. Now, it looks an awful lot like parabolic SAR, but it's not. And I spent a year testing this before I brought this to my group in hit and run candlesticks and right way options. Okay, and I can tell you without a doubt, this has improved the trading lives of tons and tons of people. This is not a buy sell indicator. In no way, shape, or form. Price is the buy sell indicator. I want to be really clear on that. In fact, I will go one step further and say there is no buy sell indicator out there except price. So what I have set up here, let me even give you the settings for this indicator. I spent a year testing all the different kinds of settings. For me as a swing trader, this works the best. It works great on intraday charts. It works great for long-term trades. And I'll show you that here in just a second. So 10 period, average true range, 1.5. Now, I set my uptrend to green and my downtrend to red, so it's very easy to see. Now, I'm going to give you the really quick and dirty rules on this. When we are underneath the red dots, we are underneath resistance. Okay? If we want to trade a long trade, we don't want to trade anything below resistance. If you want to improve your win-loss, you want to improve your win-loss ratio, okay, wait for the stock to cross from red to green and then wait for the low-risk entry in the trade. So let's go back well, let's take a look at a stock SQ. Hit and run candlesticks, right way options. We have traded this thing to death for a long time. And you can see how incredible this stock is trending. Just up and up and up and up. What was the first rule of being successful in trading? Find a stock proving it wants to go up and just wait for the next entry into the trade. And that's what we've done. So these pink lines right here that you're asking about, these were alert price levels that I was watching for entries into the trade. Let's take those off here for just a second and let's take a look at get rid of this, just the volatility stop. Darn it. There we go. I want to get rid of all those lines. So the entry into the trade, we're looking for low risk entry points. So we wait for the red volatility stop to turn to green. Once that green volatility stop shows up there, I set the alerts right on the chart. TC2000 is great. It's really easy to do. I can show you how to do that if you want. So I'm waiting for the low risk entry into this trade. Well, if you look at this, where do we have a buy signal that's as close to the volatility stop as you can find? See, if I mark the trend on this chart, you're going to find that all of a sudden, these signals start popping out. There's the trend. Okay. Can anyone see an opportunity of maybe catching an entry right here? Nice little tight consolidation. Buyers step in, very near trend, above the volatility stop. Now the volatility stop is showing us support. Okay, that's all this is showing us. Support, resistance, and trend. One more time, it is not a buy-sell signal. The price action is the buy-sell signal. So in this trade, you can see a really easy entry right into here with a stop loss that would be very close, right? We don't have to have a stop loss that's 10 miles away from a trade. We can take very low risk into positions. Now, how about this one right here? Move on up, pull back. How about that entry signal right there? Whoops, wrong drawing tool. How about that entry signal right there? Very close to the trend, a stock proving it's wanting to go up, and you take almost no heat on the trade. It's very, very simple to do. Now, I had the question, can this be done on intraday charts? It absolutely can. Let's take a look at like Facebook and go to a 15-minute chart. Can this work for this? I told everyone in Right Way Options on Friday, Facebook was a short. If we take a look at the daily chart, it looks like this. There's the failure at price resistance. Okay. On a 15-minute chart, where's the entry into the trade? Wait for green to turn to red, wait for a rally back and a failure at or near price resistance. So we fail, consolidate, try to rally, excuse me, try to rally back. Here's our failure pattern here, our break of support, and that move. Any of the short-term traders and right way options made about 30% on Facebook on Friday. Just following that. Now, I want you to notice here, could you make money going long this same strategy? Red turns to green, wait for the low risk entry point. You guys see them? It's pretty simple, right? You could have entered there. You could have entered there. There's your 15-minute trade. There's another entry into that position on up. Stop losses on those entries are extremely close. Yeah, this was a gap up the next morning right here. Okay. A balance of power is a proprietary indicator of Warden Brothers or TC2000. It's a whole nother class in itself. I don't want to spend a whole lot of time explaining it, but if you jump over there and subscribe to my YouTube channel, there's tons of free training on there, and I talk about balance of power in several of the videos, how to use that so you can get that education free. It's a really nice little tool. Okay, but I got to be honest with you. The majority of the time, it's going to be just simple price action that's going to get me into a trade. Excuse me. Now I have people that ask me, can this work for a long-term trade, a position trade? Let me show you a trade in Microsoft. There's the weekly trade in Microsoft with a volatility stop on. Does anyone in here have a tough time seeing that trend? You could, it's an average true range for Ninja. You would just have to do the programming, and I would just take the code that you can get from us from Thinkorswim and find someone, if you know how to write the code for Ninja, have someone reverse engineer it. Yes, it works for Forex, it works for futures, it works for anything. Yes, here at the end, I will give you a link where you can get my ebook on this, plus a series of videos, free series of videos on how to use a volatility stop, plus the setup for TC2000 and the setup and code for Thinkorswim. Okay, and you can reverse engineer that for any platform. It's really a fairly simple indicator. Okay, now if you look at this in Microsoft, and I'm going to put some lines on this chart because I want you to notice that hit and run candlesticks, and excuse me, right way options, we picked up this trade right here on that candle, that little green mark that you see on that chart. We picked up that trade with a leap option in right way options in December of 2016. Look at the volatility stop. How smooth and consistent this trend is. How easy this was to trade. Well, we ended up getting called away on a trade. We sold calls against that long-term trade, and we ended up getting called away in August of 2017. So we held this from December 2016 through August 2017. At the end of that trade, we'd made a 99% return on that single position. And we've traded this multiple times since. Okay, it's not that hard. Let's take a look at a Nike trade. I just closed a Nike trade this week that I recommended to everyone in Right Way Options that they take a look at this. Entry into this trade was right there. So back here in August, that's when we got into this trade. I closed this trade this week for 92%. Do you guys see how easy this is to follow? Wait for the low risk entry at or near the volatility stop. Wait for the trend to come into play. And notice how consistent that is all through these charts. It doesn't really matter. Just wait for the trend. Wait for the trade to come to you and enter the trades. Can there be anything simpler than this? There's no prediction required here. We don't have to do anything fancy at all in our trading. Just simply waiting for the trade to come to us. Now, when you look at a chart like Nike and realize that these trends are happening around you all the time, doesn't that almost make you sick to your stomach that all of this has been missed? When I was getting ready to quit trading, I thought, how in the world could I be messing things up so much when all of these trends were around me and I wasn't paying attention to them? Yeah, I draw my trend lines. I mean, extremely simple to draw. I mean, all you got to do is draw the trend. Now, if I get more connections to a trend, I know what the question that you're asking there, TJ, is do I use the wicks or do I use the bodies of the candles? If I get more touches to the wicks, I will use the wicks. If I get more touches to the body of the candle, I use the body of the candle. I closed Nike because I was in my last month of the option contract that I had purchased. Okay. And if we look at it on a daily chart, I think there's a high probability because of the amplitude of this move, there will be a pullback. So I'll just wait for the next entry into the trade. Okay. And I don't know about you, but 92% is okay with me. Okay. Yes, this will work with futures. It will work with anything. It's really, really simple. And by the way, these numbers that I use for the indicator, you can literally, you can change them, do anything you want with them. Okay. But these are the ones that I found to be most effective for me as a swing and position trader. Okay. Now, someone asked me, can this be used in a downtrend, a stock that's moving lower? Let me go back to an old chart just because it shows so well for a downtrend. Chipotle Mexican Grill. Okay. Here's a really short-term downtrend trade. Green turns to red. We have resistance. We wait for the failure to occur at resistance, and there's your short trade. Right back to support. Not that difficult to find. What about a longer term trade? What could we do with a longer term trade? Well, I want to show you back over here. During this period, could you have traded this short here? This went for better part of a year. How about if we look at it on a daily? Could that trade work on a daily for the short? Remember, the rules are very, very simple in this. We are going to wait for green to turn to red, and we're going to wait for the failure pattern at resistance. How about right there or right there? That's a good entry right there. It works over and over and over. And the long trades, red, turn to green, wait for the low risk entries to get long. Notice that all of these were trending. Works for intraday, daily, weekly, whatever time frame you choose to trade, it works. It's fractal. Okay. It's fractal. Now this trading platform, this is TC2000. That's my charting platform that I prefer to use. I do trade through Thinkorswim. I am actually also trading through a new platform called TradeHawk, and I will be moving all to TradeHawk here soon. But all of these, this indicator is available for those platforms, and I highly recommend you take a look at that platform. Okay, so let's look at a couple more charts. We got just a few more minutes. Take a look at a couple more charts. How about Apple? Could we have made any money in Apple following that simple trend? That simple trade. Red turns to green. You can see where my price alerts are. The pink lines are my price alerts. Trend is pretty darn clear, right? All we have to do is wait for the trade to come to us. Okay, here was a price alert. I was waiting for this to pull back and pop up. Well, look what happened. It didn't pop up. So by me not anticipating the entry into that trade, I didn't get caught holding this long into that mess. No anticipation in doing this. Make the trade come to you. How about Lily? Every one of us in Right Way Options saw this trade coming and this major breakout coming long before it happened. Here was an alert, and you can see how that trade has performed. Now, you can also see Lily could be setting up right now. How about Berkshire B? Anybody think they could have made some money with that chart? Simple, easy trend, waiting for the trade to come to you. A good question. Do I enter on the pullbacks after a breakout? I will tell you, if I'm confident in the market, so for example, right here, this nice little resting pullback come right back to trend, buyer stepped in. You can see my alert was right after these two little top dojis. Okay, so I wanted to catch that if it did pop up off of there. Trades like that, I will enter intraday. If I'm confident in the overall market, if the market's not doing something funky, I will just enter those during the day. But is it acceptable to wait? Yes, you could choose to wait for the pullback if you want to. I don't mind. I know a trend, the only way a trend can continue to be a trend is the last breakout. The breakout has to break out or we cannot trend, right? So stocks will move like this, but the only way they can stay as a trend is to continue to break these highs. So if I can get an entry here where I have the lowest risk entry into the trades, I will take that risk in the position. I don't have to wait for the breakout to occur. Okay, because I'm following the trend. All right. So, hey guys, I'm kind of running out of time here. I want to take just a couple seconds to tell you how you can get some more information on this. I wish I could spend all day showing you this stuff and teaching you this stuff because I have a tremendous passion for this. I love helping people make more money in their trading. And we do this all the time in Right Way Options. I mean, it's really simple. I spend 2 hours every single day in Right Way Options training from 11 a.m. Eastern time to 1 p.m. Eastern time every single trading day. I'm in the trading room answering questions, preparing trades, showing people trades, and teaching the strategies that we use, okay? Every single day, twice. I mean, every single market day, twice a month on the first Saturday and the third Saturday of every month, I do an e-learning session. So I don't know too many services that spend that much personal time helping educate, teach, and show you a simple way of making money. Okay, so go to my YouTube channel. Okay. If you go to my YouTube channel, here, let me give you the direct link. I think I can do this. Well, maybe I can't. I don't know where to post this.
Well, you can put it right in the where it says chat at bottom right, where it says to all audience.
There we go.
There we go. Yeah, see it there.
Okay, that's my my link to my YouTube channel. In my YouTube channel, there is a series, and the series is called A Simple Method for Consistent Profit. So I'm going to give you the link to the first video in that series. Now, the first video in that series is all about volatility stop. Okay, it's a whole training session on volatility stop. 5 videos there, and in the description of the first video, you will receive that you can download, okay, my ebook on the volatility stop indicator. Okay, nothing fancy about the ebook, but it gives you a lot of good description on how to use it, how to trade it, short term, long term, however you want to use it. And also, inside the ebook, there's links. Okay, the link in the ebook will take you to a bonus package from the ebook, and you can download the setup for TC2000. You can download the setup for Thinkorswim with all the code. You can download a video on how, because I saw this question, on how I build a watch list of trades. Okay, that's in there with my scan code. With my scan code. Okay. So you can get all that free. And also, please subscribe to that YouTube channel if you don't mind, because there's tons of free information on there. We do public webinars twice a month through Hit and Run Candlesticks and Right Way Options. And you're always invited to those. They're free, completely free. Okay, so please think about coming on over. Now, the last thing I want to do is I want to tell you just really quickly that every single day we put out possible trade ideas. Anybody can access this. You can even download our phone app. Our phone app, just search your app store for HRC Trading, and you can download the phone app. And this stuff comes out to you. It's free. So plan trade ideas every single day that go out. And I mean planned, fully planned trade ideas every single day. And I'm going to give you this link, and everyone, I want, hopefully everyone will be there Monday. We're going to give you free access to not only Hit and Run Candlesticks for a full 30 days, but Right Way Options for a full 30 days. These are our live trading rooms, moderated all day long. We're live in these rooms, helping, teaching, pointing out trades, and we share our trading. I share every single trade I make, nothing hidden. As a matter of fact, I show a platform with the actual trades, and we cover those trades every single day. So nothing ever hidden. I don't have anything to hide. I trade simple, I keep it simple, and if you guys can find something out of that that would be helpful, we'd love to have you come over and check us out. And yes, do I do personal mentorship? Yes, I actually am very busy as a personal coach. I work with people individually as a coach on improving their trading. Okay. I don't have the code for Metastock available. What I would do is I would take the code that we provided for TOS and give it to someone that knows how to program Metastock. Okay. And then ask them to reverse engineer it. It really isn't a tough code. So feel free to do that. All right. Any other questions, anyone? I'm out of time here.
Doug, terrific presentation. Love the transparency. Lots of great feedback for you. Thank you so much for joining us this morning.
Thank you very much. I do appreciate it. And thanks to everyone for being here today. Everyone, take care of yourselves. I wish you all kinds of success in your trading.
Thank you, Doug. Same to you.
Thank you.
All right, our next speaker is Mark Sachs. Mark, I don't know if you can hear me. If you can, please let me know and I'll give the presenter controls over to you.
I hear you.
Hey, Mark, how are you?
Hey, good. How you doing?
I'm good. I'm good. Great to have you on.
Thank you.
Thanks for joining us on a lovely Saturday morning.
It is. It's real pretty here. We're in South Florida, so weather's really nice.
You're making me jealous here. All right. Let me know if you've got the controls, and when you put up your screen, I will let you know when I can see it. I can see it. I do see a right line trading slide. I'm assuming that's what I'm supposed to be seeing.
Yep, that's it.
All right. Let Vince to give you get Vince to give you a proper intro.
Okay, thank you so much.
Excellent. Okay, so up next is Mark Sachs, and he started his career as a mathematician, contracted by the U.S. Navy, where his expertise was the optimization of software. He then moved on to teach finance at Jefferson University, and he saw a need for a trading system that could help predict the future price of any given trading instrument. He decided to create his own software, and that's when the RLT system was created. His goal was to teach everyday people to make money from home, working minimum hours. Mark, thanks for being part of this and welcome. And I'm really looking forward to your presentation.
Thank you so much.
Thanks, Mark. You got until 20 minutes after 12.
20 after 12. Okay, appreciate. I got the stopwatch set.
Beautiful.
All right. Well, listen, everyone. Thank you so much for coming out this afternoon or this morning for to give me your time. I'm Mark Sachs from Right Line Trading, and just a quick disclaimer that all signals and trading opportunities provided are for educational and demonstration purposes only, and Right Line Trading takes no responsibility for any profits or losses that you may incur. You know that the risk of trading is significant, and never risk more than 2% of your trading account on any given trade. And it's possible that you should really consult a certified commodity trading advisor before making any trade. So with that said, let me tell you a little bit about myself. That was a very, very nice introduction, but I just want to go over a little bit of it again. I'm a graduate of the University of Pennsylvania. I'm a former professor at Jefferson College in Philadelphia. I've published close to 15 peer-reviewed articles in first-tier journals, which actually you can still Google them under Sachs MK. I think they'll come up second page now, or maybe third page, because I published them about 15 years ago. And I've been involved in the financial markets for over 20 years. And our software is the product of over a decade of analysis of price action, market structure, and indicator algorithms. And the software is based on mathematical modeling of closed systems using multivariable equations. And we are one of the fastest growing trading systems on NinjaTrader. And in the introduction, the U.S. Navy was mentioned. And in my graduate work, what I did was underwater decompression schedules is another type of closed system. And deep divers for the U.S. Navy would during the decompression phase, when they would come up, it was very, very dangerous 20 years ago. It was done via trial and error. They had to stop at certain times to allow their blood to all the gases in their blood to equilibrate again with the outside pressure. And it was, again, a trial and error system. And a lot of these deep divers got the bends, wound up in underwater decompression chambers for a significant period of time. And some divers actually died. So I worked with the Navy with a program called ASOP, which is Automatic Engineering and Optimization Program. And what we did was we optimized these deep dives, mathematically modeling all of the independent variables associated with doing this dive. These were physiological parameters that had to do with gas mixtures and in the blood. And we really came up with optimized underwater decompression schedules. So when I completed my training, what I thought would be very, very helpful was to apply these same principles to each individual financial market. Each market is simply a closed system, and the way it moves out into the future is determined by certain forces. If we know what those forces are, then we can predict where price is going to move out into the future on any given financial instrument. Now that requires us to really pretty much put present dogma aside, since day traders and swing traders have been losing money really for the last 20 years using most of the indicators that are out there now. We all know the problem is that they're lagging indicators. They aren't leading indicators. And the only thing that we're interested in is a system that allows us to lead price and is going to tell us where price is going to move out into the future. And I'm going to show you today is our Unirenko trading system, or our three-line V2 system. And I think you're going to see that it's unlike anything that you have seen in the past. And I want to spend a lot of time looking at a live chart. I'll take all the questions at the end, but I'll put up any instrument that you want. In the futures market, I don't have a Forex data feed connected, or I could show you that, but I have a stock feed connected and I have a futures feed connected. We'll look at any financial instrument and you'll see how well this is going to predict for you how price moves. And we have a lot of top step traders in our room who are fully funded, who make money with us every week. Now, again, I don't want to be repetitive, but it's a mathematically modeled system, which means that we're always looking to optimize it. Financial markets, another problem with current trading techniques is they don't take into account the changing environment of the markets. Like recently, the E-mini has been very flat. It's had decent volume, but it's lost a lot of volatility. It's true of all the index equities like the Russell, the NASDAQ. Well, the NASDAQ's been pretty volatile, but not the Russell, not the Dow. We've tweaked the system to take into account the lower volatility present in a lot of the index equities. And this is the same science that's used to create a lot of the software that the big companies like Google and Facebook use. Now, again, you can use it on any futures market, any Forex pair, or any stock. And the indicator system is only forward-looking. We don't look at anything that lags price. We only look at things that lead price. Now, one of the first things that you have to decide is what kind of chart are you going to trade. You really now have a lot of different possible ways you can look at price. You can use a range chart. You can use a time chart. You can use a tick chart. You can use a Renko chart, and now you can use a Unirenko. And I know that Renko has lots of different permutations. There's tons of modified Renko. There's wicked Renko. So you have to decide what's the best way that what chart is going to best define what traders are thinking when you look at price. Now, for many, many years, I was a total tick chart devotee, and the reason is that tick charts only have one independent variable in what determines how they move, and that is how much price changes. If you're trading, say, a 10 tick chart, you're going to get a new candle every 10 ticks, every 10 pips, or every 10 cents. Time is factored out. Ticks are factored out. The only thing that changes here is based on market movement. And market movement is what really defines price action and market structure if you want to trade via the use of Japanese candlesticks. I'm going to talk briefly about them. Now, this is a tick chart, which I've traded for years, and here's a Unorenco chart, which we've now moved to. And I'll tell you, optimized Unorenco charts, without a doubt, are going to provide you with the best entries. They're going to define a trend real well. They're going to remove a lot of the noise that you don't need to see. And they're really going to give you great entries. I'm going to show you that on obviously it's not a live chart, so to speak, because the market isn't open, but I'm going to show you on a chart, not just a stylized JPEG. Now, there's trade-offs in everything that we do. Unorenco charts do this. They obliterate some price action. I don't think you get a good as read on a candle per candle basis as who's in control of the market, the bulls and the bears. I.e., if you're a Japanese candlestick devotee, you cannot read an engulfing candle, a dark cloud cover, a piercing candle, a doji, a shooting star. And I taught these patterns for a long time because I believed in them. You can't discern a rising and falling triangle, a bull flag, or a bear flag pattern. Now, I just want to say something very, very quickly about all of these patterns, because I don't want to run out of time, and I know I have until 11:20. You cannot. When the Japanese developed Japanese candlesticks 400 years ago, they made a supposition that is no longer true today. Now, this doesn't take away from some of its power, but it diminishes its power, in my opinion. And listen, there are a lot of right ways to do things, and there are a lot of wrong ways to do things. And I'm not dogmatic about the way that I trade. I trade successfully. And if you come aboard with me, you're going to trade with me for 2 months. And I trade the live markets every morning. But I think the Japanese candlesticks have lost a lot of their power for this reason. 400 years ago, when the Japanese developed these patterns, they made a supposition, which you're not going to read about. The supposition is that the power of each individual trader was equal, i.e., if trader A wanted to take a financial instrument long and trader B wanted to take that financial instrument short, they were going to be equal in power in determining price movement, so that they would create these candlestick patterns based on thousands of traders all having exactly equal power. Well, that's just not true anymore. The institutional traders destroy these types of patterns. When they move in, they just run the market in an individual direction. And there are actually some commercial traders who have a lot of money, and if they throw in a 50 lot or a 75 lot into an instrument that's sort of thinly traded like the DAX, they can completely change its direction. This is less true for stocks, for most stocks, but it's true for thinly traded stocks, and it's true for a lot of futures markets. So in my opinion, candlestick patterns are diminished in power. So in giving them up with Unorenco, we don't give up a lot. Now, Unorenco filters out a lot of noise that's unimportant to us in determining how we're going to trade. But in CHOP, you can get really hurt in Unorenco. And I've seen lots and lots of lectures with traders talking about systems based on Renko bars. And Renko is terrific in a trend, but in a choppy market, it can really destroy you. So that's why you need a leading indicator. And I mentioned this in all my webinars, and if you've heard me talk before, you know that our goal as traders is not to get winners. Our goal as traders is to avoid losers. That's called trading with specificity. If you try to get every winner, you trade with sensitivity. If you try to avoid every loser, you trade with specificity. So what I do every day in the trading room is I work to avoid losers. You're always going to get winners. An everyday trader and swing trader always gets, I think, a lot of winners. What they can't avoid are the losers, and that's what sinks them. That's what our goal is to do. Now I want to skip these charts. Now let me show you the core indicator in our system. It's called the 3-line V2 indicator. Now, why does it have forward-looking ability? And I want to go over each line with you carefully, but I want to move sort of quickly because I really want to get to a live chart and I want to have time to answer questions. Now, the first line looks at momentum, the second line looks at the stochastic, and the third line looks at order flow. Now, momentum and stochastic have been around forever. Order flow is relatively new, but what makes this a forward-looking indicator? Now, let me just talk really quickly about order flow. If you want to know more about this, I'll be happy to talk to you and be happy to teach you about it. But we look at the market delta of every candle. Now, this is a little blurry, I'm sorry for that, but this is a 2985 or 2,985, which means on the dome of your trader, market depth is bigger on the buy side. So there are more buyers looking to buy this financial instrument than sell it. So the candle is likely to close up. So an order flow tracking and market delta analysis of each candle is very powerful, but it has a drawback. Now here's a positive delta on a down candle. Remember, we're not looking at executed buys and sells. We're simply looking at market depth. Here, there were more buyers on the dome, but more traders actively executed trades. So the market delta is not an absolute predictor of the direction of a candle. And this is the problem we have to get around in order to use this metric to help us determine where price is going to move out into the future. So what we do is this. Let's just take it. If we look here at a whole series of candles with the market delta above it, you'll see some candles with a positive delta closing down and a negative delta closing up. And that has been really the conundrum in order flow tracking and trading market delta forever, that it doesn't absolutely predict the direction of the candle. And these kind of plots down below are useless. They're simply determining the absolute value of the delta, but as the delta rises, the candles can be falling. So it doesn't have any value. So what do we do in order to make this metric useful? Well, what we've determined is that one standard deviation's worth of data is correct. And what we have to do is kick out the outliers. And if we can kick out the outlying data, just use that one standard deviation's worth of data, then almost always the market delta will predict the direction that the candle's going to close. And how do you do that? Because that's not easy. And here's how we do it. We don't look, no assessment that we do is made off our trading chart. If you have an indicator that assesses data from your trading chart, it has no forward-looking ability. So we uncouple our assessment from the trading chart and only look at the two higher multiple Unorenco charts, which is simply a way of saying we look at the longer term time frame candle charts. In this case, we look at a 2 multiple and a 3 multiple. And we look at the market delta value of each of those candles. And then in order to get rid of the outliers, we put them into a 15-period simple moving average. Now, when both these 15-period simple moving averages are sloping up on both of these higher time frame Unorenco candle charts, we know that the bulls are firmly in control of the market. When both 15-period SMAs are sloping down, we know the bears are firmly in control. And when these two 15 periods are not in agreement, we get a yellow line, and we know that our higher time frames are not in alignment. And then you're going to see that really defines chop, which is what we need to know to stay out of the market and avoid losers. So here's an example. Now, this is a leading indicator and not assessing price on this chart. It's looking at the 2 higher time frames only. Now, when order flow turns green, it means the bulls are firmly in control of the market, and it's going to turn green before price rotates. And here it's going to turn red before price rotates down. Now, if you're trading, if part of your problem is you get stopped out and you find yourself in the wrong direction of a trade, it may very well likely be that you're trading in the wrong direction with regard to order flow. You have to respect this line or you're going to run into big problems. And it doesn't matter whether you swing trade or day trade or what the financial instrument is. This holds true. Remember, if this is truly an independent variable, it is instrument dependent and time dependent. It doesn't make any difference what the time frame is, and it doesn't make any difference if you're looking at a stock, a future, or a Forex. If it works and if it's right, it's going to work on all of them. There's just another example. This pivot, this up pivot came after the order flow line went green. And you can only trade long as this line is green. Here again, order flow leads price. Up, the yellow, no trades, red, only short, green, only long. Now here, when it keeps changing color, you're going to get chop. And this is when you're not going to trade. And when you get green, you're going to get a good long trade. And remember, our goal is to create very low risk, potentially high reward trades. We don't want low risk, low reward. We want low risk, high reward trades. That's how we become profitable traders. Now here's the assessment of momentum. And what we do is the same analysis. We look at the 2 higher time frames only. We don't care about what's going on our trading chart. And we look at the slope of the MACD line versus the signal line. When the MACD line is accelerating away from the signal line, momentum is to the upside. When it's accelerating towards the signal line, momentum is to the downside. Now, the ultimate assessment is a little more elegant because we actually look at the MACD crossover as well. But for instructional purposes, what we're going to talk about right now is we look at the slope of the MACD and it's accelerating and in the direction it's accelerating, either towards or away from the signal line, and only on the 2 higher time frame charts. Excuse me. My son always calls me when I'm giving a talk. So we look at the 2 higher time frames, and we look, and it shouldn't be momentum. This line should be when both MACD lines are accelerating away from the signal line, our momentum assessment is green. When both MACD lines are accelerating towards the signal line, our momentum assessment is red. And when the momentum lines are not in agreement, we get a yellow line. Now we're going to put them together. And now remember, these are both independent variables that predict the future direction of price, and they must be both aligned in the same direction to take a trade. So now we're looking at order flow and we're looking at momentum. They're equal forces. And if they're not aligned on our higher time frames, they're again going to define chop. So we look for red as it to pull this market down, and green to shoot this market up. Now, unlike 99.9% of the charts that you're shown, these are not green because price is rising. Price is rising because these are green. These are not looking at price on your trading chart. They're looking at the higher time frame charts. That's why they lead price on your trading chart. Now, it could be an hour or two before you get a setup like this. If you're in a choppy market, you have to sit on your hands. But what you're doing when you sit on your hands is you're avoiding losers. And that's our goal, is when the market doesn't align for us, we don't trade. And we make the market come to us. We don't go to the market, and we don't chase a trade. That's one thing. If you come into the trading room, you're going to get. You're going to be in there with 150 traders, all sitting on their hands, yakking away, passing the time without feeling the need to press the mouse out of boredom. And over trading is one of the biggest problems that day traders and swing traders face. This will keep you from making a grand in a morning and then continuing to trade and giving it all back. And here's again, now you need both lines aligned. If you don't, you've got chop defined. Remember, it's not looking at price here. Price is chopping because these lines are not equal, both green or both red. When they both turn red, you've got to go short. And when they both turn green, you got to go long. Now, I haven't shown you an entry yet, and I'm going to. All we're looking at is the absolute direction that you have to trade. This is right now, we're just looking at a directional indicator, not an entry indicator. And here's just another example. And we have guys in the room that can sit, that when they're there can pull 80 or 90 ticks or pips or cents out of a move, because when these stay green, there's no reason to exit the trade. You can run with this trade. And recently, like the NASDAQ has been breaking down. You can stay in the NASDAQ for a long move to the downside. That's what you want to do. You want to milk every trade for as much money as you can, so you can make your profit target and then get out. Chop, only short. Even though you get this retracement, you're not in it. Order flow and momentum are red, and you're going to wait for price to roll back to the downside, because that's the low risk, high reward direction to trade. And finally, the stochastic. Now, stochastic is also a little bit more elegant a determination that I'm going to talk to you about, because you're going to see how we evolve. This is going to become a simpler and simpler assessment to work with when we trade. We simply look at the signal line versus the stochastic line. When the stochastic line's above the signal line, the stochastic is green. When the stochastic line is below the signal line, then it's red. Now we look at the two higher time frames, not anything on the trading chart. Now a little bit more is when the stochastic line is overbought or greater than 80, stochastic is always assessed as green. When the bulls can push the market into an overbought condition and keep it there, then the position of the stochastic line vis-a-vis the signal line is irrelevant. And when the bears have the power to push the market into the oversold condition and keep it there, then we don't care whether it's above or below the signal line. The line is always going to be red. In between 20 and 80, that's when we look at the position of the line, the stochastic line versus the signal line. Now, we also assess the stochastic divergence, although I have to tell you, 90% of divergent signals are run over, and we don't trade them. Everybody, I always go by consensus, and I wanted to program it out. I have so many traders in the room, they want to keep the signal in, but we ignore it. And I'm going to show you how the stochastic line will actually tell you when you have higher time frame stochastic divergence. So now we have three lines that have to align. And it becomes tough because you have to have your crosshair. Remember, this is an intra-candle assessment. The lines can be changing color. They don't change that much, but they change some. So let's make the assessment easy. Because you want to focus on your price bars. You don't want to be focused on what's going on below price. So what we do is we take the assessment and we project the results directly onto the candle, making the ultimate assessment really easy. And here's how we do it. When the candle halo is yellow, it means you have no, I'm sorry, this is gold. It means the 3 lines align to the downside. When it's blue, it means the 3 line is aligned to the upside. And when it's black, it means you have no alignment. So the only thing that matters is what the position of the 3 line is in at entry. And you're not going to bail on the trade, because what you're seeing here is stochastic divergence. Stochastic divergence. And the move is going to get run over. So you look at the candle halo at the entry position. Now remember too, you can control the color and you can control the thickness. If you don't like this is sky blue, you can make it green. If you want it thicker, you can make it thicker. These are all alterable inputs in the back end of this indicator. So here's here's a good way of reading it. You can see that you have a down 3 line on an up candle. And when you see that, that's that's an issue. If you're not in the trade, you're going to look for price to roll and go short. Here, up, down 3 line on an up candle, and you're going to look for price to roll to the downside. Up 3 line, a down 3 line on an up candle, and you're going to look for price to roll. Here's an entry, here's an entry, here's an entry. And you don't have to look at the 3 line at all. Now, if you want the workspace to be as simple as possible, and since all the data is projected directly onto the candles, what I do is I make my 3 line invisible. Now, a lot of traders want to see it, even though the data is projected onto the candles, but I make mine transparent and it disappears from my trading chart. So now what I get, I don't have the 3 line. All I have is the assessment I need to make a trade. I have order flow, stochastic, and momentum in a multi-time frame alignment on both higher time frames aligned to the upside. I've got an entry here, and I'm going to go long. There's my second long. There is my short trade. Here, it's the same slide. Here's your short trade, 3 line, candle halo. Now you're going to get this intra candle with plenty of time to get into the trade, 1 tick below the close of the candle to the downside, to down. Entry, long. No entry because you have a black halo. No entry because you have a black halo. Here's your entry short. Now to trade with specificity and take low risk, high reward trades, you're going to have to give up some trades that are going to go on to win, but they're high risk entries, and they're entries in which you don't want to assume the risk. But just stay out of the market when you don't have an entry based on a 3 line assessment. And I'm telling you, in the trading room, every time, once in a blue moon, I'll try to take a trade without the 3 line in my favor, and more often than not, it blows right up in my face. So trust me, it's very dangerous to do when you're trading against order flow, stochastic, and momentum made on a multi-time frame basis, assessment made on a multi-time frame basis. Now here's the entry. We use what's called an exponential oscillator. Now the signal is not absolutely required, but it does decrease the risk on a trade. The reason we use an exponential oscillator is because Unorenco candles move in an exponential fashion. They don't, tick charts and range charts move arithmetically. Unorenco and Renko move exponentially. You need an oscillator that's going to be fast, because when you move into a trend with a Unorenco system or a Renko, it's going to move quick, and you need this to stay up with price. And here's the system. Now here's a signal. You have the halo, and up you go. Now these are just overbought signals. Ignore these because we've removed those. Here's your long trade and up. Here's your long trade and up. Here's your long trade and up. Now, I don't counter trend trade ever. We have a very special 50 that I'm going to talk about when we move to the chart. When we're above this 50, we always trade long. When we're below it, we only trade short. So we're looking for the long oscillator signals here, 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 and here that align with the 3 line to give us a long trade. And these are very low risk, high reward trades. And here's another set. Short, 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 and short. You're not going to take the counter trend oscillator signals long. You can, but I think they're too risky. And I don't need them to make all the money I need to make or want to make. I don't need to trade counter trend. Now, here's the way the signals are generated. When the oscillator line crosses the 50 line on the exponential oscillator, it'll generate an up triangle. When it crosses to the downside, it'll generate a down triangle. Now, when it gets below the 20 line, these are all overbought or oversold, excuse me, signals. I've removed those because we ignore them. Here's an oscillator cross to the upside and an up triangle, oscillator cross to the downside, and a down triangle. So I'm not going to go to the offer. Let me show you. Now, here's where we're going to go to some slides. I've got 8 minutes, and let me show you some slides. Now, this is crude oil. And in a couple of minutes, I'm going to go and I'm going to show you any instrument that you want. Now, for this webinar only, and only for the first 10 people who purchase, we're going to add what's called our background bias indicator. Now, not only do we want to trade when we have a multi-time frame alignment of order flow, stochastic, and momentum, we want to only trade when we have a multi-time frame alignment of the instrument we're trading. In this particular case, it's crude oil. This background is telling us that we have a 3 time frame alignment to the upside on crude. And this is when we get the best trades. You can trade without background bias, but background bias is but when you don't have it, that's when you're most likely to get chopped. When those higher time frames are all moving in opposite directions without alignment, that's when you're going to wind up taking losers. And that's our goal, to avoid them. So we're going to look for a long trade above the 50 off support with an oscillator signal and here's our trade. And here's our short trade. We have 3 in a row. Now, this isn't a stylized JPEG or something that I'm creating. This is probably at 1150 a loser. Now, the one thing that's very important is, obviously, I'm never going to tell you that we get 100% winners, but you want to trade when price is below the 50 and this 15. This candle has not broken the 15, and so it's a very risky trade. Here, price is below them both. This 2/3 of the candle is below. That's part of our trading rules. Here, is 3 more trades in a row. All winners. All off resistance. Now this one doesn't have the 3 line, and it doesn't have the 3 line. Winner and winner. You know, no background bias, we don't trade. Here's another winner. Here, there's no 3 line. See the 3 line here is a line to the downside? And look, how far does the trade go? Nowhere. You have no 3 line here, the trade goes nowhere. No 3 line here, the trade goes nowhere. Now, this is a small trade. It's a 5-tick first target, and you're going to make it. Here is a winner. Now, unfortunately, you don't have background bias here because that's a huge winner. And here you start picking them up again. Winner. Winner. No 3 line, no trade. Not below the 15. Here. Winner. Winner. No background bias. Riskier trade. Now, the 50 and the 15 are not simple or exponential. What we did was we combined both a simple and an exponential formula to create a hybrid moving average. This is a 50 period, and this is a 15 period, but they're neither exponential or simple. They're a combination of both. And they really do track price and create really relevant areas of support and resistance. And here's your perfect trades. Remember, you don't need many of these in a day to walk away with a lot of money. I mean, this is a very, very big trade. Here's a small first target. That's all you need. You need to trade consistently to get into low risk setups. Here's another winner right here. So I can do this all day. Listen, about 80% of your trades are going to work. Here's the 3 line. No 3 line, no trade. It doesn't work. Here's the 3 line. It does work, but it's too risky. Here's the 3 line and the entry, and up you go. There's your low risk, high reward trade. Now, I want to stop here. I only have 3 more minutes. Let me show you the offer. I only showed you crude, but all I can do is guarantee you, and I'm going to guarantee the software, that this is going to do the same thing on any financial instrument that you look at. It does not matter. Now, let me go from the beginning and we quickly show you my offer, and then I'm going to answer the questions. I'm only gonna have 2 minutes, but I want to answer them. Let me go to the bottom here. I'm sorry. I've got about 22. Here we go. Now, the Trend 3 system is normally fit $14.99. This is a lifetime license. You get free upgrades and free add-ons for life. It's active on any market and on any time frame. You can trade anything with it. It's $599. And included in that, it's not 1 month in the live trading, which should be 2 months. You're going to get a 10-module educational training session. And you're going to get 450 videos in our video tutorial library. And the first 10 orders get that background bias, which is really a great trading indicator to tell you the best times to trade. Now, it comes with a money-back guarantee. If you don't like the software, anytime in the first 30 days, just send us an email or call us on the phone, and we will refund your money. The offer's at rightlinetrading.com/Sachs. special offer. It's good till Sunday night. Only the first 10 get background bias. Now, it's only active on NinjaTrader, but we can power your NinjaTrader with your present platform, and you can take the signals off a NinjaTrader and trade really any platform you like. If you want to trade live on Ninja, you have to have a Ninja account. If you don't want one, like if you want to be on Thinkorswim, Thinkorswim will power Ninja, and you take the signals off of Ninja and just add them on Thinkorswim. So it's rightlinetrading.com/special offer. Let me answer one question, and then I'm going to end, because I know that I'm running into time, and I don't want to do that. Here's chat. I can't find the questions box here. Hold on. Nope. Oh boy. Okay, well, I can't find it. So if there are questions, I'm sorry. Here's our phone number, 786-713-5276. You can call us now. Rory's on the phone, and he'll answer any questions that you have. And I'm a minute over, so I'm going to go. I'm sorry about the questions. But again, rightlinetrading.com/special offer. And it comes with a full money back guarantee. I promise you this is going to help you trading, and you'll trade with me for 2 months. So I wish you the best of luck. I really want everyone to make money. That is really my goal. So have a great morning, and thank you so much for giving me your time. And thank you for hosting me. I really appreciate it.
Hey, Mark, thanks so much. Really great presentation. And go enjoy some of that Florida sun now.
Thank you so much.
Take care. All right, our next speaker is Mary Ellen McGonagle. We're going to bring Mary Ellen on in just a moment. Vince, we're flying through. This is, as I said, this is our 4th annual Trading Wins Fall Kickoff.
Some great content so far.
Yeah.
Some great ideas.
All right, give me a moment while I get Mary Ellen set up. Mary Ellen, can you hear us?
Yeah, I can hear you fine. Hopefully you can hear me.
I can, yeah. I'm going to just give you the presenter controls in just a moment. Let me know when you...
Okay, I just wanted to make sure of how to share my screen. Oh. Can you, I see it. Perfect.
Yes. Oh, I do see your title slide on the screen. Very classy. I'm going to get Vince to give you a wonderful introduction here.
Sounds
Good morning, Mary. How are you?
Good, thanks. How are you?
Great, thank you. And thanks again for being with us. So everyone, our next presenter is Mary Ellen McGonagle, and she started her financial career at the very young age of 21 when she went to work at Goldman Sachs right out of college. Since then, she has been a portfolio manager, financial analyst, and professional trader. She's a seasoned veteran and is not just another newsletter publisher pushing information that's already outdated by the time investors read about it. She's excited that the investing playing field is more level than ever before, and she looks forward to helping individual investors and giving them a leg up in the market. Mary, I'm certainly excited about seeing your presentation. Welcome again. And,
great, thank you. I appreciate it.
Mary Ellen, you've got until 5 minutes past the hour.
Okay, sounds great. I'll go ahead and get started. This is, yes, Mary Ellen McGonagle, and I'm the founder of MEM Investment Research. And a little bit more in the way of background, I do have quite a bit of experience both on and with Wall Street, but a good bulk of my career as it relates to equities was with William O'Neill and Company. And it was during that period that I worked with top portfolio managers and analysts around the world, really advising them on the broader markets and teaching them the O'Neill methodology. And for those of you not familiar, Bill O'Neill is the founder of Investors Business Daily, and that is a publication that's designed to help individuals get in front of these big winning stocks. So it is an approach where, and I'm currently using that with my own firm, MEM Investment Research, always on the prowl for that next stock, getting in front of it as it takes off. And so that is really my focus. I work a lot with high growth stocks, but they're also high quality. These are stocks that need to have strong earnings and sales. I need to see the fundamentals in place, and then we can marry them with the chart. So today, I'm going to be sharing with you one of the key metrics that is used when identifying stocks that are poised to really explode, take off, and outperform the broader markets, and that is using volume. And now it may sound simple, but it really is a critical component. So we're going to take a look at volume and how it plays in when you use it with other metrics when viewing your charts. So let's go ahead and get started. Very briefly, I have a disclaimer, and I am going to be using a lot of work in the way of examples, and a number of them are current, but I did want to make sure that you knew that it was primarily for educational purposes. This is not, there aren't going to be any explicit buy and sell recommendations today. So let's take a look at what we're going to be covering. The first is why volume is so important. We'll go ahead and get into that. 5 really distinct and powerful things that volume in a stock can signal. And then also we're going to take a look at some technical indicators that really work with volume. I didn't mention this, but in my work throughout my many years in the industry, I review thousands of charts each week, always on the prowl again for that big winner. And within that work, I'm going to be sharing with you the indicators over my many years and many, many charts viewed, those indicators that really are the most powerful and tend to work the best. And of course that with volume, and then accumulation versus distribution, how to use that, and then lastly using history as a guide, and that's where these examples are going to really come into play. We're going to be using prior examples simply because trends within the markets most definitely will repeat themselves. That's a real basic tenet of technical analysis, is the concept and the fact that history does repeat itself. So taking a look at prior examples is a really powerful way to educate yourself when you are trying to understand how the market works and how you can benefit from these indicators that are available to you. So let's go ahead and get started at the very beginning. And really, why is volume so important? And I'll tell you why. When you are looking at a chart, and we are going to be reviewing a number of examples, the volume that you see displayed, and oftentimes that will be on the bottom of your price chart, that volume, when you are looking at it, about 80% of it on average is going to be institutional activity. And by that, I mean these large mutual funds, hedge funds, and that is going to be their footprint, if you will, on the chart. And so a lot of these larger mutual fund managers, because they have so much money that they're putting to work, it's really important to pay attention to their activity. So when you see a stock move on big volume, it really is going to be a very, very telling signal. It's something that you are going to really want to pay attention to. These mutual fund managers have teams of analysts with their feet on the ground. Oftentimes they will have information, not that it's not available to you as an individual investor, but quite simply it's information that they've uncovered through their due diligence, and you will want to pay attention. It's very critical when you see stocks trade on high volume. And so really, what does high volume mean? Well, quite simply from my work, I am looking at volume that is greater than its average over the prior 50 days. And this is when I'm looking at daily volume. And then also I do a lot of work with weekly charts, longer term as well, and the volume at the end of the week is going to be equally telling. So generally it is above average volume that you want to be on the lookout for, and we'll go ahead and show how you can tell that. And then accumulation versus distribution, and this is a fairly simple metric. Really, when a stock is going up on volume, it's indicating that the stock is under accumulation, that there are more buyers than sellers. And then of course, distribution as the stock is going down on volume. And oftentimes this will be a trending type of action. And we'll go ahead and take a look at how you can key in on that so that you can take advantage of these trends when they are occurring on volume. So let's take a look here. I talked about 5 things that higher volume can indicate for you. And the first item is, I talked about this, institutions are involved. They are active in that stock. They see something as far as whether it's positive or negative. But again, this is critical because these institutions are they create these charts, so you will want to pay attention to their activity. Stocks beginning an uptrend, and oftentimes, in fact, most of the time, when a stock begins and enters into an uptrend, it occurs on volume. So that's one item that it can indicate, and also the stock beginning a downtrend, again, using volume as well as these other indicators. And volume will also provide confirmation of a move. And by that, I mean, when you are looking at your charts, a lot of my work, I look for patterns, stocks emerging out of whether it's a base pattern, a saucer pattern, and so forth. When a stock breaks out to the upside, when it occurs on volume, that is really going to provide you with confirmation that that breakout will sustain. So it's giving you that confidence that the move that you are anticipating very well may have legs. And then lastly, volume can indicate industry group rotating in and out of favor. And so when you are looking at individual stocks for purchase, it's really quite critical to, from my work, from my many years of experience, you want to pay attention to what industry group that stock is a part of. And as many of you may know, the markets are broken down into sectors, and we are currently have 10 various S&P sectors that stocks are assigned to. So when you are looking to get involved in a stock, you want to make sure that the stock you are looking to purchase is in an industry group that is in favor. And we're going to get a little bit into that so that you can, again, make sure that the wind is behind your sails, so to speak, because industry group attribution is really, really critical to the action within your given stock. So also, we can talk about using volume to go ahead and pinpoint your entry and exit points. So oftentimes you'll see stocks that will gap up on volume, and many times it could be driven by earnings reports or news. But when that occurs, you will want to buy on the pullback. We'll get into that. Stocks, when they break key support, and so we'll be looking at some of the metrics I use to determine support, but when a stock breaks that key support on volume, you will want to exit. And then I talked about stocks breaking out of bases and chart patterns. And when, again, that occurs on volume, you do want to pay attention. So really, you want to have a system to screen for these high volume events. A lot of trading platforms do offer this already. So you should be in good standing there. If you have a watch list, you may want to overlay the ability to give you and signal an alert when high volume events occur. So let's go ahead and dig in. I do have a fair number of examples that we are going to be reviewing. And this first chart that we are looking at, I use stockcharts.com for a lot of my work. And this is a charting platform that is available at no cost to investors. They certainly have the ability to upgrade, but basic charting is at no cost. So it's a wonderful service. So what we are looking at here is a daily price chart of E-Trade Financial. ETFC is the ticker symbol. And so what I have done here, I apologize for this, but what I've done here is gone ahead and overlaid a number of technical indicators, and we can go ahead and review precisely what they are and what the signals are that they are providing you, again, all with an eye toward volume. What is the volume activity on this particular stock? So up here above the price information, what I've done is overlaid what's called an RSI. That's a relative strength indicator, and it is a momentum indicator. Very briefly, without getting into too much detail, you do want to pay attention to not only the slope of this RSI line, upward of course is positive, but also the position of it relative to this dashed or net neutral. So this RSI, as it trends above that net neutral, it is viewed as having positive momentum. And then of course on the downside, as we see not only the downward sloping of that RSI, but also the position. So as it gets below this net neutral, that is negative. So that's your RSI. Let's go ahead and move down to below the price chart. What I've done is overlaid what is called the MACD. That's a moving average convergence divergence. This is another momentum indicator that can be really quite useful. Three items here that you want to pay attention to. One is the black line crossing below or above the red signal line. So as it crosses below, that's negative. And then secondly, the position of the MACD relative to this net neutral. So if it's above it, generally you are in good standing. But if that MACD trades below this net neutral, that is negative. So one other area as far as key indicators, I've overlaid some simple moving averages. Quite simply, they're smoothed out lines that are displaying the historical price history. So this green line is your 10-day simple moving average. The red is 50-day, and the blue is your 200-day simple moving average. So again, and I'm sorry, my system is being a little jumpy here today, but really quite simply, you want to pay attention to not only the slope of these simple moving averages, but also the position of the price of your stock relative to that. So hopefully you can see how clearly when you're 10-day, you want to use a 10-day for these faster moving. Those are the kind of stocks I tend to traffic in. These faster moving stocks, you can see where this 10-day acts as support while the stock is in an uptrend, and then quite oppositely, it acts as resistance when a stock is entering into a downtrend. So now that we've covered that, let's pay attention and take a look at those volume metrics. And down below here, you can see that I have the volume bars. The blue bar is indicating that on that given day, the stock closed up for the day. Red indicates down. And really what I wanted to point out to you here this is a great example because it's giving us not only getting into an uptrend, but also how you can spot when that uptrend is over, all by using the volume metric. So let's take a look down here. I'm taking you back to April of this year, and you can see these significantly higher bars that where the stock closed up on that given day. So taking a look at this first bar here and the actual price history on that given day, you can see that the stock gapped up on volume, and then quite simply you can take a look at your other indicators to see if they are also flashing positive. So I talked about stocks coming out of bases, and that means that the stock is currently hitting a new near-term high, and it's doing so on volume. So if you didn't get into the stock back here, certainly this super high volume day should be alert you to the fact that this stock has in fact entered an uptrend. You're getting that confirmation from the RSI as well as that crossover signal on the MACD. So as long as your stock is now entered into an uptrend, you're in good standing. But let's take a look at some of the metrics when you can tell that that uptrend has ended and potentially you're entering a downtrend. So here we are in the beginning of June. The stock begins to break below this key simple moving average. Take a look at the uptick here on the volume. So that at the very least is a warning shot across the bow, so to speak, because your RSI is still positive and your MACD, while it's sloping downward, it's still in positive territory. You can very well still stay with the stock, but having known that these negative volume characteristics were in the background, you can then the next time the stock does break down, take a look at this huge volume. Now the stock has broken below both key simple moving averages. Now you're getting those other flashing negative signals. The RSI is negative and your MACD already had been trending negatively. Now it's below that net neutral. So now you should have, you're given 4 different signals, all with volume as your primary driver, telling you that this uptrend has in fact expired and it's time to move on. As we move further, as you are getting other volume, really quite simply paying attention to those volume bars, you can see that the red, the volume on those down days is quite a bit higher than the blue up days. And really quite simply, that is another characteristic of a stock that is under distribution, and you can see graphically that the stock is very much still under distribution. So that's our first example. Let's go ahead and move on. Here we are looking at Amazon, and again, this is another daily price chart. This chart is a little dated, which is fine. It's going back to the beginning of this year, but it's still going to be really quite effective in pointing out to you how this volume can really play into your trading decision making. So here we are back at the end of October 2017, and Amazon did come out with very strong earnings. The stock did gap up in price, but take a look at that volume. That volume is 400% above the average daily volume for Amazon over the last 50 days, and you can see that the stock did in fact continue to advance rather significantly from this particular gap up. But again, that volume is really signaling to you that institutions want in, they want to have this stock in their portfolio, and they are, for them to accumulate a position in a stock, by them I mean these big institutions, it's not going to happen overnight. Oftentimes it may take up to several weeks for them to gain a full position in a given stock. So that is why when we see this big volume, it's really oftentimes just the beginning of their accumulation in this stock, so you can take advantage of that. And then also taking a look, here is activity in February of this year, and the stock during that period, this is the broader market, had a very difficult beginning period. We went into a correction in the beginning of this year, and of course not many stocks were immune to it, Amazon among them. So Amazon did in fact break below its key 200-day simple moving average. But what I did want to point out to you here with this high volume day, while it was red, it did close down for the day. It ended the day in the upper portion of its trading range. And that's really quite bullish when you have the stock undercut a recent low, yet trade in the top portion of its range on big volume. And that was the beginning of an uptrend. The stock was able to withstand the downward pressures that were occurring elsewhere in the markets. But again, that volume was going to be really key in pointing you toward that. So here's another daily price chart. This is Align Technologies. This is a more recent chart, and this, as part of my work, I put out a bi-weekly newsletter where I'm putting out stocks that look attractive and poised to go higher. This is a stock that hit our screens back here. We had it on during other uptrending periods as well. But let's take a look at why this stock would pick up and pique our interest back in this May period. So what we are looking at is a daily price chart. Each bar is 1 day of price activity, and you can see on this given day the stock was trending downward, not anything of interest from our work, but on this particular high volume day the stock broke back above these key simple moving averages, and it did so on very big volume. So that was our first signal that there may be a shift in sentiment. The stock may be potentially poised to enter an uptrend. It did for the next few days, not a lot in the way of activity. Volume dried up. But let's take a look at the action when the volume did pick up again. And that is taking us into this period here, higher volume action. Your RSI is turning positive, as is your MACD. The stock breaks out of this base on very big volume, and you can see where it entered into an uptrend. And then throughout this uptrending period, by and large, your higher volume days are on up days, and that is signaling the stock is under accumulation. So that's another example again of using this volume. Let's go ahead and move forward. This is Paycom. We're looking at another daily price chart, again a recent chart, but what I wanted to point out to you here is volume signaling the shift, and by that I mean the uptrend is reversing. So here we can see the stock breaking down below these metrics, these simple moving averages. Take a look at that big volume. The stock is really just quite volatile during this whole period, not anything of interest to us, but this huge volume day is really a signal that the stock is under distribution. You can see where it is not where you would want to be positioned for the next month until we get another super high volume day here on an up day. And that was your first signal. And then additionally, we get other uptrending up on volume signals that power you into that uptrend that began in August. I also wanted to point out we're looking at a lot of daily charts. This is a monthly chart of Biogen, and I'm taking you back. Actually, this chart is going back a couple of years, but it's really quite powerful in indicating to you the power of using volume, not just daily. You can even use it intraday on your hourly charts. But here we're looking at a monthly price chart, and you can see the big pickup here in the volume, and it really signaled a multi-year move out of that base, again, all using volume. I talked about sector rotation. This is XLF, the financial sector. And what I wanted to point out to you here using this weekly price chart, this is post-election, taking you back to 2016, huge move, big volume here. And that's telling you that financial stocks are could very well be beginning an uptrend. And in fact, that was an indication. Financial stocks went on to really great heights after this big weekly up on volume. And when the stock did break below this key 50-day simple moving average, take a look at the volume. That was your other signal that financial stocks were out of favor. And this period lasted for about 8 months. So again, all keying in on this volume. So from there, once you are tuned into the fact that financial stocks are in an uptrend, you can then, for those of you that are active, you can go ahead and uncover individual stocks. This is SIVB Financial, one of the stronger names in the financial grouping. And this is taking us back to that 2016 gap up on financials post-election. This is a weekly price chart. So I talk about using charting patterns. This is a saucer pattern. The stock breaks out of that base. Big volume, you're getting your RSI and MACD confirmation. SIVB went on to great heights from there. Now, we can also use volume very effectively when you are looking at stocks. What we are looking at here is Ulta ULTA, another weekly price chart. And here I'm saying versus the broader markets. The reason I'm pointing that out is because this stock, as you can see, it begins breaking down below key support. Take a look at these big pickups here in volume. This was during a period when the broader markets were very much in an uptrend. So not only do you want to pay attention to characteristics relative to volume, but you want to compare that to the broader markets. So if the broader markets are in an uptrend, you see a stock breaking down severely on big volume, you really want to pay attention because the downtrend is can be very significant when it's counter to the market's action. So let's go ahead, and here we are because we looked at Ulta Beauty, ULTA, in the prior slide. On a weekly, we were looking at the distribution characteristics. Now let's take a look at how you can then identify when that stock has reversed that downtrend. And again, as you can guess, it is going to be those volume characteristics. So here's your first pickup here in the volume. Your RSI starts trending positively. You are starting to get more in the way of up days on higher volume than down. So we can see that the dynamics are starting to shift. We're starting to see buyers coming in all just by paying attention to that volume. From my work, it's not until we get above those moving averages that the stock is going to pique my interest. Even more interesting here as it's continuing what could be an uptrend on big volume. So let's go ahead and talk about briefly another sector that had picked up during the period of late last year. This is consumer discretionary. XLY is the ETF ticker symbol. And consumer discretionary stocks are stocks that generally are using consumers what are called discretionary income. So it's going to be a lot of retail related stocks, restaurant stocks, leisure services, travel, and so forth. So consumer discretionary stocks by and large sat out the bull market of 2017. So there was great anticipation as consumers continued to unemployment continued to decline. So there was anticipation that this group at some point would come into favor. So let's take a look during the latter period of 2017, and that in fact did take place. The big news there was that they came in with solid earnings. A lot of these retailers, there was a very strong holiday retail period. So what I'm keying in on here again is being able to spot that. Again, using volume as it breaks out to new highs. And we have a downtrend reversal here in the beginning of 2018, where with the correction in the broader markets, it was able to break back above this key moving average, and consumer related stocks have been the real winners this year. And again, from our work, we were able to spot this in the end of 17. We got a lot of our clients in front of those retailers. So it's been, again, all with using your charts and then marrying what that chart is telling you with the volume characteristics. So here's an example. Oh, this is Estee Lauder EL. We're looking at a weekly. I know we're seeing a lot of the same thing, but really it can be powerful if you can understand what you need to key in on and go ahead and key in on that. So Estee Lauder on the weekly, again, the stock's breaking out of a base, big volume. You're marrying it with your technical indicators. So as the stock enters into an uptrend, you want those volume characteristics to remain. In other words, the higher volume days are on up. That is indicating the stock is continuing to be under accumulation. And when you're marrying that with your other technical indicators, you can really stay with these stocks. This is a weekly price chart, and you can see that Estee Lauder went on for at least a 1-year uptrend beyond your picking up this breakout on big volume. So many of you may be shorter term in your outlook. What I'm showing you are weekly price charts. These charts tend to be more useful for intermediate, certainly for institutional. I still work with institutional clients at this point in time. They are more inclined toward using these longer term charts because they do cancel out a lot of the noise, if you will, that some of your intraday charts will present to you. You will stay in a stock longer with these longer term charts, but these metrics that I'm showing you are equally powerful in the intraday charting. Whether it's 1 hour, 15 minute, you are still going to want to key in on the volume with your other technical indicators and marry them together. So let's go ahead and move on. Lululemon, LULU, this is a big retailing stock that has been a big winner. We're looking at a daily price chart here. So this big volume day here, this was one of those stocks I talked about, consumer related stocks picking up in the end of 2017. This was a prime example. The stock gapped up on big earnings. Take a look at that volume. And really the stock sat out. Now this was a period where the rest of the markets were going through a correction. So for the stock to really just hold tight and not deteriorate is really big news. But take a look here. This is their next quarterly earnings report, another big gap up on huge volume. And by now the market dynamics were beginning to shift. The market pressures were lightening up a bit, so the stock was able to continue and advance out of that gap, but really just keying in on that big volume. That's telling you again that institutions want in and they are going to build their position. Here's another retailer. This is Macy's. This stock really suffered for about at least 18 months. It was in a significant downtrend, but as an investor, of course, you want to be able to identify when that downtrend reverses. And again, volume is going to be your friend, because here we have these high volume bars on up days indicating a potential shift in sentiment for that stock. And then when you can marry that with the other technical indicators turning positive, it can really get you in front of these bigger, longer moves. This is a weekly price chart. So from that period, this is another stock toward that end of 17 where it started to pick up big volume, and it went on for at least 6 months, that uptrend in this particular stock. And then Chipotle, we of course want to be on the lookout for stocks as they are deteriorating, the stock breaking down below key simple moving average. Take a look at these red bars, really a pickup in the volume on the downside. And as we can see, the stock has gone on. This is a weekly price chart. It went on to deteriorate for quite a significant period of time, but you, as you can see, would have been able to identify that. And really, we were getting warning shots back in here with these big high volume days, much more in play than the very few up days on up weeks on volume. This is another stock that's been a big winner for us, RNG, another weekly price chart. And again, keying in on that volume characteristic as the stock enters into really a multi-year uptrend. So ring central, each bar is representing 1 week of price activity. Another sector rotation, XLI, another post-election big pickup that was signified by that volume. You could have gotten into any number of industrial infrastructure related types of stocks that really picked up again, post-election. Trump talked about spending a lot more in infrastructure. So that is significant, again, as far as that volume. Here's a stock that did take advantage of that. This is Caterpillar, CAT. The stock did break out of a base, all again keying in on these volume characteristics. So for those of you that might not be on top of the market, you may not have picked up on this, you will oftentimes be given additional opportunities to get into a stock that's in an uptrend. Again, if you're able to key in on those volume characteristics. And here's a stock, this is a more recent chart. This is Weight Watchers, WTW. This was a big winner for a good portion of 2018. But here we can see the stock, in fact, we had this on our buy list, but once the stock broke below this key simple moving average, we started to get these negative signals flashing. The volume pickup here was a sign that that uptrend had in fact ended, and you are continuing to get these big down week days. This is a daily price chart on big volume. So really it's telling you that this stock, the uptrend's over. It is very clearly in a downtrend. And you can also use volume with the broader markets. I'm taking you back to 2016. At the end of 2015, many of you may remember, at the beginning of 2016, we had a flash downtrend here in the markets, but you were given a lot in the way of signals because your higher volume weeks were on down weeks. So again, you can use these volume characteristics for the broader markets. This is a daily chart of the S&P going into the beginning of this year. Take a look at these downdrafts and the huge volume that's going to tell you that the broader markets are in trouble. So let's take a look at some conclusions that we can draw here using volume to time your trading. Hopefully you can see that it's a really critical tool. And you do want to have a system in place that's going to uncover when your volume has picked up. And a lot of trading platforms do offer that now as very basic part of their platform. And then know yourself. So if you're devoted, do the work. And if you don't have a lot of time, subscribe to a newsletter. And of course, I do offer a bi-weekly newsletter. I do all the work for you as far as screening those broader markets and taking a look, of course, keeping volume, also keeping other metrics in mind, getting you in front of these stocks as they take off. So I'm going to provide you, this is a special offer for today only. I do specialize in trading momentum stocks, stocks that are on the move, both to the upside and downside. And this is a course that is going to help you uncover the best momentum stocks, what you need to be on the lookout for, how to pinpoint your entry and exits. And also there is one signal that is going to tell you that the momentum in that stock is over, and it's all covered in this course. It's offered today only for only $9. So you can use the link that should be provided here in the chat and go ahead and access that course. If you are interested, it's a wonderful course. And also, for those of you that may have any questions, I'd be more than happy to answer any questions that anyone might have. Otherwise, I do see a question. I'm not quite sure if it's for me, but it's talking about long-term trading. Oh, Rick, yeah, so I did go ahead and address that. The metrics that I am showing you and sharing with you today are can be very easily used for shorter term time frames. They're equally effective. Again, the reason I tend to use longer term charts and metrics is because I am a bit of a longer term trader, and as far as my clients, they generally want to be in a winning stock that's going to provide them a lot in the way of upside profitability for a bit of a longer term. They're not individuals that are going to sit in front of their screen each and every day. So hence the longer term, but it is equally effective in shorter term charting. So I don't see any other questions, so I may leave it at that unless there are any further questions. Vince, are you available, or someone can step in here, because I don't want to end it abruptly, but I think I see another question. Let's take a look here. And you know, I don't, let's just take a look. Oh, here we are. Yes. And moving averages. Okay, super. There is one. What setups for the red and blue moving averages? Appreciate that. Yes, the moving averages that I use are simple moving averages. Oh, this might be for someone else, because this is talking about exponential. And but while I am here, I will tell you that I tend to use simple moving averages, and the primary reason is because that is what the institutions use. So I like to key in on what they're using, because their actions are going to be determined by simple moving averages. So I want to be in there as well. So I am going to leave it at that. And for those of you that may have any further questions, I offer quite a bit more in the way of courses. My courses are very highly regarded, I will say. I get a lot of great feedback from them. But you can go ahead to my website, meminvestmentresearch.com, and a lot of the courses that I teach, again, they are designed to help you identify and spot these big winning stocks before they take off. And there's a lot of intricacy, but it's simple. It's a simple system. But what I shared with you today is really just one of many other different characteristics that are evident in these big winning stocks. So it's a really powerful system that I've developed and designed, all with using the metrics that I taught and shared with professional money managers for many, many years. So for those of you with any interest, I urge you to go ahead over to my website, meminvestmentresearch.com. There's also a contact me there. So if you have any further questions, that and there's also the ability for you, there's a special offer if you want to trial my bi-weekly newsletter. It is 90% off for that first month. So be sure and take advantage of that as well by, again, going to meminvestmentresearch.com. So I think we're pretty much out of time here. Is that safe to say?
It is. Thank you so much, Mary Ellen. That was great. Thank you again for being part of this. We have placed the link in the chat box, so anyone interested can just go straight to the chat and click from there.
Mary Ellen, great presentation. Now, I know Vince mentioned that you started your career at the ripe old age of 21, which was probably just a couple of years ago, wasn't
it? Exactly. Yes. Not too long ago.
You've certainly accumulated a lot of knowledge since then. We're delighted to have you on. Thank you so much.
Oh, sure. Of course. Thank you for having me. I appreciate it. Have a great weekend.
Wonderful. We hope we can do this again with you.
You bet.
All right. Our next speaker is Dr. Barry Burns. Now, Vince, you remember what happened last time with Dr. Barry Burns?
Yes.
He was ill. He couldn't join us. But we have him with us today. Dr. Burns, can you hear me?
Yes, I can hear you. Can
How
you
are
hear
you,
me?
sir?
I am very good, much better this time. I'm on top of the world.
Great to hear. How was your summer? Are you making money hand over fist trading?
You know, it's been a very interesting summer. What I've done is I've changed my trading a little bit because there's been a lot of money to be made in the morning and not as much in the afternoons. And so, you know, you don't have to trade all day. You can, myself and a lot of people I know would just trade for, I usually trade for like 2-3 hours when I'm day trading. And I just do it in the morning and then I'm done. So it leads to a great lifestyle. And there's been some great moves in the morning, pretty much every morning. And as far as swing trading goes, it's just looking for the opportunities, just like Mary Ellen was talking about. There's always good opportunity somewhere. Like they say, there's always a raging bull market somewhere. There's always a raging bear market somewhere. And, you know, you scan for them, you find them, and then you trade that. So I don't really have any favorite markets. People ask me, Barry, what's your favorite market? And I say, the one that's making me the most money right now. That's the one. That's my favorite one.
Lovely way to answer that question. I know I want to get you into your session ASAP, but I do want to ask you, how long did it take you to get to this stage where you can work just a couple of hours a day and have a really good lifestyle as well as make a decent amount of money?
Oh gosh, that's kind of a tough question. You know, Mary Ellen, she got started when she was 21, so she waited a long time to start trading. I started when I was 8. So I had a, back then, that was 51 years ago because I'm 59. So, you know, to answer your question, trading's changed a lot in the last 51 years, in case you haven't noticed. And, you know, back in those days, we had black and white TV, for crying out loud. So, yeah, it was a different game. So I've had to adjust and, you know, to the markets with electronic trading. And, you know, back then, when we looked at what's the price of the stock, we were looking at yesterday's newspaper. Today, you're looking at, well, what's the, you know, price this nanosecond, and literally high frequency trading and all that kind of stuff. They're literally trading nanoseconds, which is crazy fiber optics is not good enough for them. Now they have to use microwave technology. Everybody has direct access to the market. Commissions are lower. We've got decimalization on stocks. And so, I mean, so many changes. It's crazy. All the algos, half the trades in the stock market every day are done through computers, or the decisions are made by computers instead of by human beings. So yeah, I mean, I've had to, constantly adjust through 51 years. So kind of hard to say, from the time I was 8. I mean, I was doing well when I was 8, but that was because I had the guidance of my dad. My dad was a stock trader, and so he would sit me down at the dining room table and walk me through some stocks. So never really did bad, but at the beginning it was because of his protection, his guidance.
Barry, it's Vince, and you just made me feel a lot better because, I'm not too far behind you in age, and I teach a class sometimes with a technique that I call the pencil and ruler method, because back then I used to actually draw my trend lines and so on with a pencil and a ruler, right?
That's right.
We didn't have all the fancy tools that are available to us today, so I know exactly what you mean, and trading has changed quite a bit. But we're all looking forward to your presentation. You're going to be talking about price action today, and that's fantastic. If you're all set on your side, let me give you a brief introduction here, and then we'll go from there.
Great.
Excellent. So everyone, our last presenter of the day is Barry Burns. He's a businessman who has owned several small companies. His business background taught him to focus on the bottom line. So his study of the financial markets was for one purpose only, to make profits. Now he started, as he said earlier, his study of the markets under the direction of his late father, Patrick F. Burns, who accumulated 70 years of trading experience in his lifetime. And in addition, he hired 3 professional traders to mentor him personally, and even went to Chicago to work with a former floor trader at the Chicago Mercantile Exchange. Without further ado, here's Barry Burns. Thanks again for being with us, Barry.
Thank you. My pleasure. I appreciate the invitation. So yeah, today we're going to do a very interactive presentation. So we got a lot of people here. That's wonderful. Welcome, everybody. So this is not a time to sit back and just enjoy the show passively. I'm going to lay out a few very basic things. We're going to start with the very, 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 very basics. 101 of price action. And then as we go on, we're going to get very detailed toward the end. So we've got something here for the complete newbie. And we also have something for very advanced traders. We're going to go the whole gamut, but we're going to start with the basics and build, like building blocks, until we get to the super advanced stuff. And like I say, I'm going to be asking you to interact with me. So we are going to do this together. I think the best way to learn is not passively, but actually getting actively involved. And so, get ready to start typing in some answers because we're going to do that pretty soon. Oh, a couple of other things. I do have a little slide here that talks about my background a little bit, although Vince did a good job of it as well. So I'm the author of Trend Trading for Dummies. I've received Reader's Choice Awards for many years now. I've contributed to other authors' books and worked with major companies. And here's just a few of them who have obviously vetted me before they invited me to come and work with them. So yeah. Okay, now let's make our lawyers happy, because if our lawyers aren't happy, then nobody's happy. So, but all jokes aside, this stuff is very, very important. It really is, because if you think about these regulatory statements, where do they come from? They came from people's pain. So if you don't want to experience pain in your trading, best place to start is with the regulatory statements. These are so true that the powers that be have received, numerous complaints and identified in the industry where people are losing money, where they get hurt, and they require that we post some of these things. So this is part of your education. It's really where your education begins. And, unfortunately, we become regulation blind because we see this stuff so often. So I'm not going to read all of it for you, but, trading is not suitable for all people. Please only use funds that you can afford to lose, called discretionary money. All information in this presentation for educational purposes only. Use this at your own risk. Information is for general purposes. I'm not assuming any liability for errors or omissions. Basically, take responsibility understand past performance is not indicative of future results. And then I'm going to just add this to it. Most people in trading lose money. How's that for anti-hype? So no hype in the presentation today. Haven't heard any hype today anyway, so that's great. I respect that. But yeah, the fact is most people do lose money trading. So just want to add to that what we want to get out of that fact. Most people see that as discouraging, but actually that's pretty much how life is. The Small Business Administration says that most traditional businesses that start up, in fact, about 80% of them, they go out of business in 5 years. So trading is not unique in this way. The stats are there pretty much across the board, Pareto's principle, if you will, the 80-20 rule. But what that really means is that, yeah, you're gonna have to be good. And to be good means you gotta treat this as a profession and not a get rich quick game, because it's not get rich quick at all. It really is a profession. And like any other real profession, it takes time, education, and some real effort. And that's going to be your biggest edge, is that you're going to take it more seriously and work harder than the guy on the other side of your trade. Okay, so today I'm going to talk about price and volume. I always use this with my 5 energies. So I'm not going to go in my 5 energy method too much here, but just real quickly to give you an outline of my methodology. It's called the 5 energy methodology. And so I look at these 5 energies. When I say energy, I'm talking about the energy of money. Money flowing in, money flowing out. If you want to think of it as supply demand, that's fine. So the first energy I look at is trend. By the way, there's only 5 things I look at, so that makes the trading simple. And we need it to be simple to prevent mental overwhelm. You must protect your mind. And that means keeping your method as simple as possible. Now, you can't make it too simple. Einstein said, make everything as simple as possible, but no simpler. And I don't think Einstein was a day trader, but that still applies to trading in general, whether you're a day trader, swing trader, and whatever. Because we've got to keep things simple to protect our mind, as I said, but no simpler means that we need a number of uncorrelated variables to establish a probability scenario. So those uncorrelated variables, here are the 5 that I use. Number 1, trend. I always start with that. And are we early in a new trend? Because the trend is our friend until the end, so we want to get in at the beginning. That determines which side of the market we want to be in, long and short. And then is the trend strong or weak? That's your energy of momentum. If the trend, even if you're early in a new trend, but it's weak, I don't take the trade, because that will not follow through. And Mary Ellen actually talked a little bit about that. Cycles. So if we got early in a new trend that's strong, now I've got a market I want to trade. Then the third question becomes when to get in. All right, that's where my cycle indicator comes in. By the way, I'll share with you my cycle indicator. I've got a indicator that works just amazingly well, literally identifies every single cycle high and cycle low in the market. And I do sell it, but for you guys, I'll give it to you for free. Stick around toward the end. And about 30 minutes, I'll show you how to get that for free. In fact, I got nothing to sell today. I kind of dropped the ball. I'll give you one of my courses for free. How's that to make up for it? It's like, yeah, I know you guys are all bummed out, like, come on, Barry, I can't, I'm on this webinar to buy stuff from you. And now you don't have anything to sell me. Well, I'm sorry, but I don't. So I'll just give you one of my courses for free here at the end. Support resistance is the 4th thing we look at, because we want to cycle low to come in at support or cycle high to come in at resistance. And these are all on the same time frame. Then we look at scale. That's the multiple time frames. I want to make sure the next higher time frame is also the energy of momentum of money flow is also in the direction of my trade on the shorter term time frame. So that's my method in a nutshell. Quick overview. Okay. So the reason I say that is because I'm going to be focusing on price action today and volume, but just want to let you know that there's more to it in a complete trading methodology. Okay, now this is for the newbies. Price bar, 1 bar price logic, and I'm going to be using candlesticks today. I use candlesticks in my trading. So real quickly, this is a bullish bar. Okay, this is like the Barney episode of trading. So make it real simple here. So the market, when it's green like this, when the real body, this is called the real body, it opened here, it closed here for this time frame, whatever it is, by the way, it doesn't matter what time frame it is, for this one bar, then it opened at the low, closed near the high, made a little higher high here, ended up closing way up here. It's a wide range bar. So there's two factors here. Number one, how wide range is the entire bar? And then how wide range is the real body of the bar? So that's a very bullish bar. Okay, exact opposite, very bearish bar, opened at the high, closed near the low. Yeah, the lowest low of that bar during that price period, a little lower, but it closed way down here at the bottom. Wide range bar, wide range real body, very bearish bar. That's one bar price logic. Now here's another type of bar that is also one bar price logic. So what this is, I'm going to bring up my little handy dandy drawing tool here. In fact, let me change the color on it. Blue, I think, would serve us well today. Whoops. Okay, there we go. So now, again, we have a wide range bar. Okay, and that's key, by the way. We'll look at narrow range bars too. But wide range bar, and it opens and closes near the bottom of the range of the bar, within, let's say, the bottom 25%, or at least the bottom third. This wick, I'm going to call them, I like to call them wicks. Some people call them shadows. Either term is appropriate, I guess. But I like to call them wicks just because, well, you know, real literal candlesticks have wicks. I don't call them shadows. But shadow is a proper term in Japanese candlestick linguistics as well. But here's the deal. So this whole price range here, that is called a rejection of value. That's actually a market profile term from market profile theory. And what it means is that the market, it covered this range of price action, but the open and the close were just down here. So after all was said and done during this period, let's say it's a daily bar, the market participants decided, no, after all of this, we decided, no, this is what the market's worth. According to market profile, markets work on the basis of an auction place. So what is something worth? It's worth what someone is willing to pay for it. And so the market as a whole rejected these prices. Yep, there was some buying and some selling up there. But when all is said and done, the market said, no, we're not going to accept those values. These values are rejected. Okay, so therefore it's a bearish bar. It is a bearish bar. Doesn't matter, by the way, that it's green. I actually put it intentionally up there that it's green because some people get enamored with green, red. Ooh, wow, green means up, red means down. Not always, not always. And so in this situation, the fact that the real body is so narrow range, whether it's green or red, yes, it did close above the open. That's what that means, literally. But it's such a narrow range, doesn't really matter. Okay, there's some noise. You got to allow for some noise in the market because the markets are so big now, international, people trading all different time frames, all different techniques, all different things. So therefore, you got to allow for a little bit. You can't look at this stuff down to the pixel on your screen. Markets are not that accurate. Okay, there is a bit of randomness in the market, a bit of chaos. So same thing here. Again, but this one is a bullish bar. And again, I actually used the example of a red bar because that really, again, doesn't mean much here. Fact is, open and closed in the top third of the bar. All this down here, rejection of value. So therefore, the market decided, yep, we have rejected all these lower prices. And so therefore, the market is bullish during just that one period, just that one bar. All right. That's one bar logic. Now, let's get tricky. Let's add a second bar. So now we've got two bar logic. All right, and I'm not using the traditional Japanese candlestick terms today, and I'm doing that intentionally because I'm just trying to teach you the logic of the bars. So I'm not going to talk about engulfing bars or shooting stars or hammers or any of that stuff. That's all cool. It's all great. But today, just want to focus on the logic. I want you to understand what this stuff means and not just memorize a bunch of terms. So this is a two-bar bullish pattern. All right, so this red bar here, that was bearish. This one's bullish. And so what I say is that this green bar invalidates the bar before it. because the bar before it was very bearish. This bar is very bullish. And so this bar invalidates that bar. We have changed the market sentiment, if you want to look at it that way. The market sentiment has changed. All right, so it invalidates the bar before it. Here, same thing, 2-bar logic, but this time it's a bearish example. The red bar invalidates the green bar, and now we are in a bearish mode. All right, again, using our second example, 2-bar logic. So again, this is a bearish pattern. Why? Because, well, we had our green bar, bullish, and then look, we closed there, we opened there, the market tested these prices and rejected them. And therefore, even though they were tested, sure, but market sentiment, the masses in the market, general consensus is nope, we can't get any more buyers up there. Can't get enough buyers to make the market go up anymore. And so it's rejected any higher prices. So that's a 2-bar bearish pattern, and the inverse, a 2-bar bullish pattern. Okay, so now that you got the basics, what about this? Well, this is the second bar here now is just a neutral bar. Neutral for 2 reasons. Number 1, the range of the entire bar. Remember, we're always looking at 2 things. So the range of this entire bar is narrow range from the high to the low. Second thing, the real body is narrow range. So everything about that bar is very, very neutral. Again, the fact that it's green, I don't care. Now, the fact that this one's green, I do care because the real body is very wide range. So this one, nah. So what is this? Well, that bar is neutral, but the 2-bar logic is that we are still bullish. We are still bullish, even though the second bar is neutral. Therefore, it just means the sentiment has not changed. And so we just stick with the sentiment of the first bar. Okay, now let's get into the fun part. Now let's get into the interaction. So are you ready to do some work? Okay, so here we go. We're going to do a few examples. Now that you know the basics, so you see this really cool little magenta arrow down there, very high-tech stuff here. So here's the question. For the bars marked, did they validate or invalidate the price action of the bar that precedes them? So what about this one? Go ahead and type in. I actually can't see your answers, so you don't have to worry about being wrong because I can't even see your answers. And by the way, if you are wrong, good. If you get something wrong today, if you get an answer incorrect.
Barry, I've opened up the question pane for you.
Oh, thank you. Thank you. Awesome. Okay,
so please feel free to call out the members who have wrong answers.
All right. Oh, now you guys are going to be held responsible. All right. Awesome. Well, the market will definitely hold you responsible, so you might as well get used to it. If you want to learn responsibility, oh, the market's very good at holding you responsible. Okay, thank you for that. Yeah, that'll make it even better. Appreciate that. Okay, so, and some of these are going to be trick questions. I'm going to warn you. Why? Because I want you to learn, okay? So if you get something wrong, as I was saying, I want you to shout hip, hip, hooray. Why? Because you'll learn something. There is no losing today. Today we're practicing, so there's only winning or learning. Those are the only 2 options, okay? And like I said, some are going to be trick questions, and that's intentional to help you learn. So, and I won't call out any names here, but let's just see, maybe later I will. So go ahead and type in. Now I can see your answers. Does this green bar validate or invalidate the red bar before it? Go ahead. It's a 50-50 chance, multiple choice question. So we got validate, invalidate, invalidate, WMT. I don't know what that means. Invalidate, invalidate, neutral, invalidate, validate, invalidate, invalidate, validates. Okay, so we got a pretty even split. And that is actually very appropriate. What we're getting here is a little microcosm in your answers of the market psychology that's going on. So we've got about a pretty close to 50-50 split of some people who say it validates, some people say it invalidates. Guess what? That's what makes a market. Every time you buy, there's got to be someone on the other side of your trade, right? Who's saying you're wrong. So that's pretty cool. I used to do seminars where actually went into a big room, hundreds of people there, and we had this big screen over top, and I would put up charts like this and ask people, you know, how many think this is the market's bullish or bearish or what it's going to do next. And it was always about, you know, roughly 40-45% each way, and then, you know, the balance of people who just saying, we don't know, we're not sure. And one of my points was, see, that's what makes a market. You got to have someone on the other side of your trade. So the way I would look at this, by the way, is that it is neutral. So if you said neutral, I agree with you. It doesn't validate or invalidate. 2 reasons. Number 1, the green bar is not a wide range bar. It's a fairly narrow range bar, and that's all relative. When we talk about wide range bars, narrow range bars, we're talking about relative to the other bars. So that's a wide range bar. These are narrow range bars. That's a narrow range bar. These are definitely narrow range bars. That's a narrow range bar. That's a wide range bar. So this, again, because it's so narrow range, it's basically just neutral. Yep, it's green. Now, here's the other learning moment that I'd love to share with you. It happens to people all the time. And I know because I've dealt with it. By the way, every mistake that I share with you is mistakes I have made. So there is no arrogance here whatsoever. I'm teaching you from my mistakes what's the best way to learn from other people's mistakes. So learn from my mistakes today. I made a ton of them. When we're analyzing charts historically like this, we have a bias because we can see what happens next. And so we have a way of our brains just looking at this and saying, oh yeah, that's a bullish pattern. No, that's just your brain seeing this and coming up and creating a reason for it. And that's why I say, and we're going to do this in a minute, when you analyze charts, you have to do them on the hard right edge of the screen. Otherwise, yeah, you get this forward-looking bias that is absolutely useful. Well, it's deceiving is what it is, very deceiving. Okay, so now that I messed you up with the first trick question, how do you like that? Isn't that nice of me? Very first question out of the gate is a trick question. Now, what about this bar, that red bar right there? Let's try it again. Validate or invalidate? Okay, good. Invalidate, invalidate, invalidate. Very good. Thank you, Chris and Larry and David and Brian and me. I didn't type anything in. Somebody used my name when they logged in. Or else there's another Barry Burns out there. Paul, Jim, good. Oh, we got 100% right. Correct. It invalidates. That is correct. Why? Because it's a wide range bar. It engulfs the bar before it. And yeah, wide range real body. So very good. So now that one does invalidate. Yep. Very good. Oh, somebody asked if it's narrow range bar, doesn't neutral basically mean it validates? Yeah, I can see where you would say that. It doesn't change the sentiment. So yeah, that's, we just say, yeah, it would kind of be that. That's not a bad point. That's a pretty good point. Okay, very good. I like that. Good insight. See, you guys are smart. Okay, what about that bar? Validate or invalidate the price action before it? What do y'all think? This one's a little tricky. I'll grant you that. And by the way, as I'm saying, it's a little tricky. Another very important principle in trading. Very important. Muy importante. See, I know 2 Spanish words, and those are them. Now I've exhausted my Spanish vocabulary today. One of the key things in trading is if you're not certain, like Paul says, ambiguous. Yeah, so very good. If you're not positive about any signal in trading, whether it's price action or an indicator or moving average or whatever you're doing, if you are not certain of what that signal means in your trading methodology, do not take the trade. It's an automatic pass. Just default to don't take the trade. So I actually monitor my own thought process and my own self-talk. And if I find myself saying, well, it looks kind of anything like that, immediately I say, oh, wait, I just caught myself showing uncertainty. And therefore, I'm just not going to take the trade. The market can do whatever it's going to do. But when I take trades, I want the highest probability trade. So I take less trades than most people probably think I do. I find that with most professional traders, we trade a lot less than most people assume. And that's because we've learned by losing a ton of money you know, that pain is a great teacher, and in trading, pain is losing a ton of money, and I've done it. That, it only pays to wait for the very best setups. So one of my slogans is fewer, better trades. Take fewer, better trades. So I would agree, that one's a little confusing. It's a doji, definitely, no question about that. It's not super narrow range, it's not super wide range. You know, we've got a little bit of rejection of value at the top, but is it really super clear? No. So essentially, all I would say is, yeah, you know, we're still going down. It hasn't really validated or invalidated the previous bar in any dramatic way. Okay, very good. And so the last one, look at this very last one. What about this one? Does this green bar validate or invalidate the red bar before it? Okay, Bernard, good. Larry, great. Awesome. Come on, people. Me, Barry Burns, gets it right, of course. Jim, good. Chris, awesome. Brian, good. David, amazing. Yep, very good. So yeah, you guys are geniuses with a capital J. All right. Good, Bar. Bill, yeah, good. So this is invalidates, right? Wide range bar, wide range real body. And so, yeah, that is a bullish signal. Very good. Okay, so you guys are catching on. You guys are smart. All right, I'm not going to go through this just because I see our time is limited here. Got started a little bit late on my part of the presentation here, which is okay. So we're not going to do that. Let's go straight to the next slide, because that slide actually takes some time, where I usually go one bar at a time. And I got I want to get to the advanced stuff at the end. So I really want to make sure we have time for that. Okay, a couple more quizzes. Based on the price bar formation, again, there's my little arrow down there. What would you, now we're looking at it on the hard right edge of the screen. So I've taken away the advantage of seeing what actually happens in the future, right? So now, answer me this, riddle me this, as the riddler used to say. What's going to happen now? What would you expect to happen from here on out into the future over the next, I don't know, 5, 10 bars or so? What do you think? Is the market going to go up? Is it going to go down? Is it going to go sideways? You basically got 3 choices, so multiple choice, but this time we're going to give you 3 instead of just 2. So now you don't have a 50-50 chance anymore. All right. Oh, you guys are really good. Yeah. Okay, good. By the way, I'm just going to acknowledge people who are answering here because I respect that you're participating. Brian, Andelco, Daniel, Bernard, Robert, Barry Burns, Chris, Marie, Gary, Eric, Steve, David. Okay, so let's see what happens. Ta-da. Okay, and there's your answer. Now, why? Why did it go up? Okay, so there's several reasons. Number 1, gap close. So some of you mentioned a gap close. Absolutely. So it does close the gap. Now, do gaps always close? No, sometimes we get gaps and goes. So just because we have a gap, that's not enough, right? We look at it and we say, okay, that's one factor. Then we have to ask ourselves, well, now, do we expect the market to close the gap or to gap and go? In other words, keep going down, because sometimes the markets do that. In fact, it's not even that uncommon, especially on daily charts. You'll see that where specialists will gap the market above or below a significant support resistance level. That's not an accident, by the way. So the way I read this, okay, this was the bar over here, is that we have our rejection of value bar, okay, open and closed in the top third of the range of the bar. This part of the price bar was rejection of value. What did it do? It retested this low. Market came down here, put in a low, came back up. Now, this is really powerful stuff. When the market retests, or I'm sorry, actually tests, not retesting, it's testing that low for the first time and opens and closes way up here, that means that this price level, this price zone was rejected by the market. When you get it at a low that's already been put in, everybody in this parakeet is looking at that. Okay, that's an obvious low. So everybody's going to be watching that on a, what do we got here, 5-minute chart. So especially right at the open like this. And so, yeah, the masses, there's going to be a consensus there among the masses who look at that. Okay, so that's the market logic as to why we would expect a gap close in this particular situation. All right, now what about this one? Again, hard ready to the screen. What do you think? Up, down, or sideways? Go ahead and type in your answers. I'm not letting you guys be lazy today. I'm making you work. Didn't expect to come and have to work today, did you? All right, well, hopefully you'll learn more by participating. Hope that. Let's see, Bill, Larry, Daniel, David, Endelco, Murray, Barry Burns, Steve, Brian, Karen. Ooh, that's a cool way to spell Karen. I like that. Harish, David, Eric, Gary, Robert, Bernard, Kim, Bill, Paul. Okay, so very good. Dang, I think we got a 100% here. Man, you guys are getting good at this now. So that is correct. It is definitely a bearish pattern. And again, 2 reasons. Number 1, the red bar invalidates the green bar. Number 2, we use support resistance with it. So again, here is your open. Ain't that what the heck happened there? Okay, my mouse going crazy. So this vertical line now, that's the market open. So we come off the open, boom, that's the first high of the day. Retrace back down to it again, similar to the last one, right? But this time it's bearish, the last one is bullish, and we get a different 2-bar pattern. So instead of the rejection of value bar, now we get an engulfing bar. And off of the high. And the bears take over. The bears take over. Anybody from Chicago here? That's where I learned trading, was in Chicago. So got to be a Bears fan out there a little bit. Okay, let's get a little more advanced now. What do you expect to happen next here? All right, again, hard ready to the screen, up, down, or sideways. All right, what do you think? Karen, thank you. Karen with the cool spelling. Bernard, Cal, Endelco, Robert, Larry, Steve, Daniel, me, Brian, Kim, Jim, David, Gary, David. Okay, well, this time we're not all getting the same answer, so that's good. That's actually good. Why is that? Why do I think that's good? Because if you all got the right answer, you wouldn't be learning anything, right? I want you to learn something. So good. So this one's a little more sophisticated. All right, so here's the answer. So this one is a little different than what we showed before. We have a wide range bar, that green bar that I identified, wide range bar from high to low, wide range from open to close. Remember, those are always the 2 things. Here's the tricky part that maybe you didn't notice because I didn't really point it out. I didn't highlight it. Didn't make it easy for you. Market's not going to make it easy for you. Why should I, right? So seriously, you don't want someone who makes it easy for you. You want someone who challenges you because the market will challenge you like crazy. So the point is here that we got a wide range bar, broke through this resistance. Notice how in all these latest examples now we're employing support resistance along with price action. Very important. They work together. Never use one without the other, especially these significant highs and lows that everybody in his gerbil will see. It closed above the resistance level. So it opened below it, closed above it, and it's a wide range bar from high to low and from open to close. Notice, by the way, we get a wide range bearish bar here. Is that a 1-bar bearish bar? Yep, it sure is. But here we had support at the bottom, a very obvious support level. But it didn't close below the level. It closed right around that level of the low, and then the market went up. That's the difference. That's the difference right there. Okay. All right. Anybody learning anything? Anything helping? Okay. So now we're going to use volume, bring in our volume. And Mary Ellen did some of that. She did more with daily charts. So what I'm going to do is I'm going to drill down for more day traders. Okay. Day traders. So, and this is a little more sophisticated stuff. So we use this along with the 5 energies I mentioned at the beginning. Volume is a little tricky, but I'm going to help you to see things that maybe some other people don't. So we're going to look at large volume versus small volume. And this is where it gets a little tricky. You want enough volume, but not too much volume. Don't you love that? Sounds like my lawyer. Well, it depends. We don't want just large volume. Now, here's the really important thing. We want smart volume. A lot of people teach you to read the volume histogram at the bottom of the chart, and that is great. Absolutely, I do that too. But now we're going to get into a distinction. In fact, there's an ancient Chinese saying that I just made up. And that ancient Chinese saying I just made up is, the dollars are in the details. I'm going to give you a dollars that are in the details example here today. Okay, so again, remember that last little bullet point there, the smart volume. Professional participation is what we're looking for. All right, not just any volume, because you could get a lot of volume and it might be all amateur volume. That means all the amateurs are wrong. That's all that means. Okay, so here we go. So we're going to bring up what's called the time and sales window. Most charting platforms have this. If you're not sure how to bring it up, just contact your charting software program. I'm going to use TradeStation as an example. And here's how I set it up first of all. So number one, I don't need my drawing tool. I'm going to use my spotlight here. So here where it says type, okay, I only want to see the trades. I'm not going to look at the bids and asks in this scenario. There are people who do tape reading with bids and asks as well. That can be very helpful, but for today's purposes, we're looking only at actual trades. Usually it defaults to showing bids, asks, and trades. Okay, but again, for our purposes today, only want to look at actual filled trades. So that's step one. Step two in setting up the time and sales window. Well, actually, this is a little different. I created an indicator here that will actually plot block trades, what are called block trades on my chart. Now, you don't need this indicator, by the way. I'm not saying you need this because you don't. Makes it easier, that's all. Well, you know, nice to make trading a little simpler, as simple as possible. So you notice how down here, this is our volume histogram, but I don't have volume under every bar. Some of them have no volume bars. Why is that? Because I've set mine to only put a volume bar where it's a block trade. And here's where you set your block trades, the size of the trade. Now this is the NQ, NASDAQ 100 futures. And so I've set this to only show trades that are 20 contracts or more. That's one trade of 20 contracts. So, okay. Now, most amateur traders are trading what? One contract, two contracts, maybe three, maybe four. Very few amateurs trading 20. And so right now, again, I just want to see the smart money. And then it'll plot where those occur underneath the bars. And that's all that I'm going to be looking at for this exercise. Now, look at this. Here's another thing. This I haven't seen anybody else do. I think this is unique to me, although as soon as I say that, then somebody always emails me and says, oh no, this other guy does that too. But anyway, I've never seen anyone else do this. So what I do is I like to use two of these windows, all right? And then in one, the time and sales window over here, I like to set, let's see, this one is set to block trades. Well, it's not really block trades, but a size of 10. So it's only going to show me a trade. Again, that's a single trade. Now remember, the person who placed that trade, they may place more than one trade, but each trade is at least 10 contracts. So they got to have a decent sized trading account. And that's all this is going to show me. Now, at the same time, I'm going to create another time and sales window. In this one, I'm going to show only, I'm going to set it to only show me trades of one or two contracts. One or two contracts. So this one is showing me more the amateur traders. This one's showing me more the professional traders. Now, just looking at those two windows, notice, by the way, prices are the same, right? 1205 3/4, 1205 3/4. So the trades are happening at the same prices. Here's the question, the Pregunta for you, the Fragen for our German friends. Looking at those two time and sales windows, would you expect the market to go up or down? Go ahead and type that in. What would you expect? Or if you have a question about this, and why? Let's make it even more intriguing. Impress me even more. Why would you expect the market to go in that direction? So if you can answer why, I'm going to give you some extra bonus points. I'll give you 1,000,000 points if you can tell me why. 1,000,000 points you'll leave here with today. What are the points? The points are Top Dog Trading admiration points from Barry Burns. That and a $20 bill will get you half a cup of coffee at Starbucks. That's how much that's worth. Okay, Daniel, David, Steve, Jacqueline, Jim, Robert, Don, Daniel, Herman, Bill, Cal, Steve, Jim, Howard, Andelco, Murray, Bernard, David, another David, Harmon. Okay, so good. I'm not going to go through you guys. Let's see if you guys got the right answers here. Yep. Right, you guys got it. You got it. See, it's not really that complicated, right? Once you understand it, it's because, right, the big players, the smart money, are buying. The retailers, or the amateurs, are selling. So which group do you want to join? Okay, we're not going to beat the institutions. So as the old saying goes, if you can't beat them, join them. This is how you can see what's invisible to most traders. And therefore I call this an invisible edge. Would you like an invisible edge? There it is. I just handed it to you on a golden platter and you could immediately see it and understand it. Nobody got this wrong. Nobody got this wrong. One last step that I do, it's optional. Actually, there's a couple extra things here, so I do like to do this. So I'll set my contract limit. This one, let's see. Oh, we still got the NQ in here. Okay, so cool. This one, I think I set it to 20. Yeah, 20 is the minimum, that's usually what I set the NQ to. So it's only going to show me trades of 20. Anything less than 20 contracts per trade is not even going to show up here. I don't want to see it. Now, another distinction that I can make is so I got green when they buy. Now look, lime green. What does that mean? That means that whoever bought that at 30 contracts, they actually paid above the ask. That's what that means. They bought above the ask. So that's an aggressive trade, or it could mean they just got a little slippage. All right. And then selling below the bid, I've got mine colored magenta. It's not quite as clearly distinguished as the red. So that's another thing that I'll do to make that distinction. And then block trades where it says block here, okay, that's another setting you can do in your time and sales window. And this I set to 50. So yes, I'll only show trades that are 20 or more, and then I have it plot block if it's 50 or more. So I'm going to give, the reason I do that is that, yeah, I'm going to give a little more emphasis, a little more priority, if you will, when it shows a block trade, 50 contracts as opposed to just 20. And let's see, all the block trades are red because there's some green ones in here, right? So there's some green ones. Pros are not always right. Plus, they could just be covering a position. Doesn't mean that they're getting in if it's green. They could be getting out of a short position, covering a short. And that's where, a little bit of, that's why you still have to use a chart with us and so forth. But then I look at the block trades and it's like, okay, that helps me to give priority to red or green, so to say. Last thing, last slide. Well, we got just our conclusion slide after this. So now a lot of people wonder, how do I avoid false breakouts? So here's one way that I do it. Here we've got a narrow range market, value area high, yesterday's low, market's just pinballing between there. Finally get a breakout. Okay, cool. Now, do we expect that breakout to continue or to fail? One way to avoid false breakouts, the bane of existence to breakout traders is false breakouts. Plot your block trades there. If you can see block trades coming out above the breakout, guess what? Smart money's buying. Probably going to sustain to the upside. Probably going to sustain to the upside, right? Increases your odds. Okay, so that's it. Here's my info. Again, I don't have anything to sell you today, and I do again apologize greatly for that. You have my sincerest apologies for having nothing to sell to you. I really feel horrible about that, and I know you do too. But what I will do is give you one of my free courses here. And you can see it there, 5-day video correspondence course. So you get 5 free videos, and these videos are very concrete lessons And again, it's kind of similar to what I taught you today in the sense that it's the, well, the name of the course is How Professionals Trade Different Than Amateurs. How Professionals Trade Different Than Amateurs. That's actually the name of the course. I probably should have put it on the slide. So there's 5 videos. At the end of each one, just like today, we've got interactive quizzes. I really believe, I'm a wholehearted believer in the Socratic method of teaching, basically asking you questions, get you to answer to commit, because when you trade, you got to commit, right? Your money on the line. So I want you to get in that frame of mind. I want you to get in that habit of having to commit even while you're in the learning process. And it's better to get answers wrong while you're learning than when you place money in the market. And then we can course correct. Right? It's called a feedback loop in sports psychology. So we put it out there, we review, we adjust, we go back into the game. We review the tape of the game, then we adjust, we go back with that new knowledge into the game the next time. So you get interactive quizzes in there. Also, this course is not just theories or ideas. I'm actually going to give you a trade setup. It's called the rubber band trade. It's one of my favorite trades. I still take it to this day. So you'll actually come out of this with an actual viable trade setup that gives you probabilities on your side. And as I said, you're welcome to get my cycle indicator for free. I sell it on my core or my website. I offer a free webinar. It's a follow-up webinar. We'll hold one this coming week, and that will help you set up the indicator on your chart. That's the first thing we'll do, get it set up on your charts. Works on any charting platform, by the way, because actually what we're doing is modifying an existing indicator on your chart. That's on every charting platform I've seen, but we modify it, turn it into a cycle indicator, and then, just like a lot of the stuff today, I've got to show you how to trade it. There's certain patterns that we trade, and if we don't get those patterns, we don't trade it. So I'll give you about a 30-minute tutorial on that. And you access all of this is accessed at the same website right there, topdogtrading.com/free.html. And hooey, that's it. I had to blitz through that really quick. That was actually a 60-minute presentation that I gave in about 45 minutes. So, so Vince and everybody, thank you very much. If you have any questions, send an email to me at barry@topdogtrading.com. Thank you, everybody. I appreciate your attendance and your participation with me back and forth, your engagement. That means a lot to me, and I hope you got a lot out of it.
Barry, always fun. Just looking at some of the comments. Thank you. Always fun. That's from Bill. Thanks from Dawn. Bill also says, thanks for a fun and interesting end of the many sessions session. A great way to wrap this up, Barry. Thank you so much for joining us today.
My pleasure. Thanks for the invitation.
We'll see you hopefully at our next event.
I hope so. I look forward to it.
All right. Take care. Folks, that puts a tidy bow on our 2018 Trading Woods Fall Kickoff. Vince?
Yes, and if you happen to join us late, not to worry. We've got everything recorded. The recording will be processed and ready by when? Monday?
Monday.
Or so? By Monday, the latest, we will have the recording available for everyone. Again, some great presentations. So if you didn't catch them, look forward to that. And again, thank you so much for being with us here on a Saturday. We really appreciate it.
Folks, have a terrific weekend, or whatever's left of it. We'll see you back Monday for an active trading session. In the meantime, as I said, enjoy the weather, enjoy the time off. See you soon.
Thanks, everyone.